We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day. As always, we have the topics of today covered in the description. You can see some of them in the title. And we're going to be having a Q&A towards the end. So if you have any questions, I'd save it towards the end. Otherwise, I might forget it. I'll try to remember if I can star it as I see them come in. But I'll be trying to do both. It's called multitasking. Okay, so James Burns, wait, did Fabio even touch CCL? Yes, I did. However, you're probably not in the club, so you don't know the whole trade. But I'll be covering that because now that it's played out, I feel like I have, I'm not doing anyone any injustices by now covering it publicly, and you guys can use that as a case study, whether you're interested in that or not. Okay, so I see the conversation being had, and I felt inspired to draw on one of the conversations, bring it towards the top so we can get this out of the way. And it is Yield Max is for Brokies. Okay, so the title, or let's call it the topic at hand, is, yes, it's meant to kind of drive a stir, be thought-provoking for some of you. But if the premise of the statement, or not the premise of the statement, but the premise of the question, is Yield Max for Brokies, is kind of rooted in who this is targeting. And I still believe that for 100%, without a doubt, that the product is geared towards or targeting people who are less fortunate. And the reason why is because, of course, it targets people who want income. And if you have a lot of money, you don't really care for the income per se, because income just sort of just comes naturally as the consequence of having a large portfolio. And we'll talk about where I see one of the commentators who has a lot of energy, always brings energy to the live streams, and that is Gil. I see you in the comments, and I want to cover this because people like yourself have stated similar arguments in the past to justify these products. I want to express to everyone watching, if you're on the fence, and maybe somehow if Gil can even understand this, why this is a waste of your time and probably not the most ideal way to achieve any sort of performance. So let's start with the basics. For one, the way these are designed, these are synthetic covered call strategies. So they create what's called a synthetic long, and they sell covered calls against that. So a synthetic long mimics or tries to achieve the returns of the underlying, being in this case Tesla, and then on top of that, it tries to generate income via covered calls. So the covered calls, simple, how you would normally do a covered call in your own portfolio. And the idea is it generates some form of income over a period of time, depending on the implied vol, etc. And that is distributed to the investor of the ETF. So there's a couple things wrong with that. Immediately, if you don't know the mechanism of options at the end of the day, you shouldn't even be investing in this to begin with. Because, for example, by buying Tesla, in this case, you're going to be taking on the same individual risk of owning an individual stock. And on top of that, you're going to experience the volatility a little bit differently. In fact, you're doing it in the dumbest way possible. I can't express how dumb it is to actually buy this product, because you could purchase Tesla, which in and of itself carries its own risks. Individual stocks, all individual stocks carry their own risk. So you purchase Tesla, you do all the work, and you think Tesla is a great investment, and you believe in it. And by the way, replace Tesla with any other, Yield Max underlying. It's all the same argument here. But you take AMZ, if you want Amazon and AMZ, same thing there. If you really believe in the company, you buy that company and you'll get all the returns. And in this case, you won't get all of the returns. You'll mimic some form of the returns, and only in a specific scenario where the volatility of the underlying is in such a way where it doesn't go up too much too fast, but it kind of goes in a certain up into the right direction. That's the rare scenarios in which a yield max fund or a synthetic covered call strategy may outperform the underlying. So you're doing all of that work, the same amount of risk, but none of the gain. That in finance does not make sense. That doesn't make sense. So, typically in finance, when you're trying to make an argument and say, okay, I'm doing this strategy, I am taking on less risk, but I'm taking on less return. I'll get less return back. Yeah, that you can make that argument. You can make that make sense, because depending on the person, depending on their goals, depending on where they are in life, that could work for them. But if you're taking on the same risk and you're not going to achieve the same return, that doesn't make sense at all. And again, we get back to the premise. Well, why do people want this? Well, of course, it's the income that draws to them. And that's, again, part of the question or the statement. Yeah, it's for Brokies. I'm using that terminology because that's something you might understand. The term Brokies, I know it's used commonly, but I don't really particularly like the term. I think it's derogatory. But however, I think trying to emphasize the point here, I think it does a decent enough job to at least play with the idea a bit. You want to say whatever you want. You can replace Brokies with people who are less fortunate, poor, etc. People who have less money, who want income and are desperate for it, will seek out these products, and that's what they prey upon at the end of the day. That's all this is for. So if you want Amazon exposure, it's easy to just buy Amazon. You'll get Amazon exposure. You'll get all the upside. And then honestly, if you have, or if you're making a lot of income, yeah, you do care about taxes. Taxes are a pain. You lose upwards of 37%. And then if you're in a state with income tax, you'll lose even more. So yeah, it does matter. It really does. It already sucks when you consider long-term capital gains, and you're at the highest income tax bracket. The amount that you'll have to give up to the tax man, I mean, that's already something of consideration. But when you're talking about these products, I mean, it's silly in every which way you put at it, that only someone who is making less money, who is less fortunate, they might make sense of the product and they might decide to take that product. Of course, like I said earlier, there's really no reason for this product's existence in the first place. And me even making the argument that I'm putting a small percentage of my portfolio into it. I mean, you're making that excuse now, but it's like, even then, what's the point? Because for example, Strongman, he did with a small portion, he bought one share of Tesla to kind of make a joke out of it. And you made a statement about it outperforming his ETF. And it's like, that's irrelevant, because in the case of his ETF, it would be a comparison of the ETF. So like VTY and VT. Tesla is going to be a comparison that you can draw from against Tesla. Using it as a comparison to VT is not comparing apples to apples. So that's another statement. I don't know if you understand that, but maybe it's important to know. Fabio, that's for employees with W-2s only. You do realize you can lower your taxes, right? Yes, Gil. Yes, you can lower your taxes and you can expense everything. Okay. So we're going to talk later about the options, because I think, Gil, you may not even understand options whatsoever. But because you bought this product. So if you bought this product, you definitely don't. I have 1,000 shares of Tesla at 40.12 share price. I'm down 24K. I get 650 month income volume paying taxes to the government. Yes. Making a lot of income and you're smart. You can avoid taxes, clown. Yes, you can avoid taxes, Gil. Oh yes, you're definitely avoiding taxes, probably. I get knock out first round. Play, are you guaranteed returns all time? No, that's a silly premise in and of itself. I'm not even going to entertain that. What are you trying to buy options? What are you trying to do? When you're trying to buy options, you're trying to capture a move or movement in the stock over a period of time. So you're basically saying, what is the direction of this move of the stock? And then over what period of time will it do that? And that's the play. And there's many different ways you can set that up. What you're doing here is you're buying a product that algorithmically does it for you, which is very silly. You don't want to do an algorithmic strategy. The fact that you don't even understand that just says, like, you don't even need to be in this product in the first place. This product is predatory. This product preys upon people who do not know the mechanism and do not know exactly what the problem is. I mean, when I listen to people, they don't even comprehend. For example, like I hear NAV erosion. People actually think NAV erosion just like means the value or the stock going down in price. That's not what that means. That makes no sense, because if you dig a little bit deeper into NAV erosion, what it means. So let's do an example. The direction of the underlying is positive, and the fund's direction can also be positive, but there can still be NAV erosion. Simply put, because when you see the volatility kind of expand a bit and the stock price goes down or the underlying goes down, you will experience the full downside. But unlike the underlying, you have to recognize the loss. When you recognize the loss, then at that point, when you recover, you don't get to recover the same amount. That doesn't happen to you, but it happens to whoever owns the underlying. So if you own Tesla, Tesla goes down and then Tesla goes back up. Well, nothing happens to you. You're just experiencing the volatility. And then when you see Tesla go down and Tesla goes down, well, when Tesla goes back up, it won't go back up the same amount. Additionally, the upside is capped. So when you go back up, if it goes up too fast, too quickly, and a company like Tesla is volatile, you will be capped on that upside. And so over time, you get that NAV erosion where the disconnect begins to expand and expand and expand and expand across the x-axis, across time. So again, when you buy this product, all you're basically shouting to the world, and that's not a bragging right to shout this, is that you are someone who is less fortunate, who is craving income, and that's your goal. That's your right to desire that. But just note that that's what you're screaming. You're not showing anyone that you're some investing genius. You're just showing everyone that you probably don't know anything about options and the mechanism underneath it. And maybe you're also telling people about your income status. So I would avoid buying these if you're trying to maximize your wealth over time. In fact, you should just focus entirely on maximizing your returns, and then income just comes naturally. You will have a hard time avoiding income. That's actually becomes the problem. You start to focus on tax strategies, ways to, as you were, trying to brag about earlier, avoiding paying taxes. That's something, a real thing that people who make a lot of money have to think about. And that's the problem that you have to think about. So that comes naturally as you grow your portfolio over time. Those who have less, they don't have to worry nearly as much. For generate income. I didn't imply anything. I'm saying that if you even state that this is an intelligent investment, you don't know what you're talking about, and that's all. And at the end of the day, if you're taking from this that I'm specifically meaning you as the Brokie, that maybe is saying something that you have like an insecurity about yourself. I'm talking about broadly speaking what these products were designed for. So they're not designed, maybe not for you specifically, because maybe you're a baller, maybe you're super rich. I don't know, but this is what the product was designed for. And that's the premise or the statement that's in the title and the statement that's listed below. So, yeah, I'm saying you're implying a lot of things, brother. I'm not implying. Maybe you're taking offense because it's affecting you in some way. I have no idea. Would you rate Fabio's bricks? My bricks are completely real, so they'd probably be a 10 out of 10. Can we have any questions? 85% of the people is a waste of time. Why are you spending so much time on it then? Because it's my channel and I can do whatever I want, and I make a lot of money outside of the channel. So I don't even care if people don't watch this channel. That's why. And if I desire to talk about any topic, I can talk about any topic. Okay, so that's not to take, I'm not mad at you, Christopher, for saying that. I know a lot of people have opinions on, what things should be spoken about. And lately, because, I'm getting pretty close to the retirement. So I'm becoming more and more like, I don't give a fuck. Well, I've actually said I was going to retire like $100 ago for Meta. So, probably do you know how to option trade? Jesus. Well, yes, Grievous. You know that. Okay, so 10 bricks are fake. Yes, I'm implying that you should probably buy VT. Actually, Christopher, that is correct. You should probably buy VT, VU, whatever you want. I don't know if you should be in individual stocks. Okay. So my Nike, we're going to talk about Nike right after. Don't you worry. Fabio, your options are no different. Why you're trying to generate income, trying to generate returns. And on a risk-adjusted basis, I think it's actually quite favorable because you don't have to risk as much. In the case of this, no, you're risking all your capital. So, for example, you're trying to capture the return and generate an income. So you have to invest X amount of money. But in my case, if I play it right, I don't have to put as much capital down to generate this equal amount of return. It's completely different. And I know you would know that if you knew options, but that's a bit of a problem when you're trying to equate the two. They're very different. And I advocate if someone wants to do options, they have to learn the hard way and do it themselves, not do these algorithmic strategies. I think that's not the answer. Again, I think these products are very predatory. They should not exist. And if anything, regulators should probably consider coming in here and basically asking the question, why does this product exist? Who does it serve? And what purpose does it serve? Because at the end of the day, the answer simply put, is they do not have one. They produce income, right? But the income isn't in the way that you might think, right? It's not alpha. It's not an excess of the underlying returns. It's actually just if you map it out over a long period of time, and I guarantee you this with any underlying product versus a yield max type product, or let's be more specific, a synthetic covered call strategy, the delta in performance is going to expand across time. And just give it time. And even when you take the periodicity of just a small subsect of these funds, I think PYPY is outperforming PayPal. And again, because I said it's if they move up in a specific interval and have a specific level of volatility, and in that case, you might find some that they might outperform the underlying. And at the end of the day, if you think about it, if you actually consider the way the numbers will work out in your retirement, all that matters is total return, and then also the risk that you're taking upon that. Because when you look at an income-based strategy approach, you want to hopefully lower the volatility because you're going into your retirement years and your income level is probably going down, right, from your job, et cetera, and you're reaching more into retirement. So you have to worry about the volatility. And so the traditional mindset behind that is you want to move closer to fixed income. That's why, because you want to minimize the volatility, and that's what a fixed income offers you. Okay. Fabio is just speculating. You can make that case about all investing, my friend. That's what all investing is by your kind of spirit of the statement. In the spirit of that statement, all investing is speculation. I would tend to disagree. I would tend to disagree because if it was speculation, there would be some sort of randomness and chaos to the success rate. It just like investing, I think you can apply the same approach. Now, with an option strategy, and again, option strategy, if you think investing in individual equities is difficult, it can be extra difficult and dangerous to invest via options. That is true. But that's not that it's like as you're kind of portraying it. There's a little bit more nuance than that. Okay. And the thing is, I do not condone it. And because I think the vast majority of people, just like how I say about individual stocks, I say the vast majority of people should just invest in low-cost index funds and be done with it. And that's the solution solved. Investing has been solved, so to speak, for most people. So it's funny if I just gave an example. Yeah, but clearly I don't know if you understood the concepts. I don't know if I can break it down any simpler for you as to why we're observing that. So it's like I said why, and I gave it to you for a reason, right? It's not that I'm hiding it at all. I'm telling it to you. But if you didn't hear it or understand it, I mean, that's on you. I think the rest of the audience, they probably heard the reason why the PYPY is outperforming PayPal and why that's a unrealistic assumption to then say that will be the same case here on out into the future. The mechanism by which these funds operate by will guarantee that as you move across the x-axis, the delta in the outcome or y will expand. All right. And it's very simple because at the end of the day, you experience the same volatility to the downside, but not to the upside. You're capped upside. If you understood how options worked, that would not be a foreign concept to you. This is why these are predatory. They target people who do not know how to do it, first of all, themselves. They target people who are less fortunate. These are predatory products. End of story. That's all. Okay. So, Warren Buffett warrant. Yes, and that's the funniest part. So you say that statement, and it's clearly not in line with what you're saying here, because if you care about the results at the end of the day, if you understood how it functions, you would know that you're not going to get the same results. You're basically saying, I'm wanting to take the same risk for less reward. That does not make sense. That is illogical, especially in the world of finance. That's illogical. You would be fired immediately. Like, for example, if you came to me and said, I want to get into this project, here's the budget, etc., and here's project A and project B. Both of them take on the same risk, but project B yields less return. Project A has higher return. I want to do project B. I'd fire you. Okay, so here we're gonna do this, and let's see if there's any further questions. Otherwise, we're moving on to the next topic, which is NKE Aftermath earnings. So Nike. I've been hearing a lot of chatter about Nike, both on Twitter, YouTube, etc. I'll share my thoughts. We covered it a little bit in yesterday's live stream, but I'll cut to the chase and not waste your time here. So, before that, let's end the poll because I always forget. So 84% of you said ETFs are a waste of time. 16%, it keeps going down. 16% of you said it's not a waste of time. I wonder, 43 votes. Wow, that's quite a few of you. Jesus, you guys watch me? What is wrong with you? Go watch Kemmer. This is not a channel for you. Okay. So Nike down 20%. Problem with Nike is, honestly, if you were buying Nike before, I really don't know what to tell you. You were paying roughly 25 times earnings for a shoe company. I can name a couple shoe companies that trade roughly for the same multiple and are growing much faster. You have On, you have Deckers, etc. And now they don't have yet, at least for now, you would argue, the same global strength in their brand as Nike does. And when I think of people who want to buy Nike, a lot of them is retail investors. I was talking to Dan and the gang, and Dan said something. I think he added me in one of the chat rooms. He's like, "Oh, these retail investors, they're going to move from PayPal over to Nike. Just watch." And I want to doubt that, but I'm afraid he's right that it's going to happen based off of the chatter I'm seeing on Twitter, on YouTube. It may end up happening that way. And I think people are really just, I don't know what they're seeing here, because I mean, now it's at a PE ratio of 22, but at the end of the day, again, you're paying a multiple in excess of 20 for a business that's growing at 2.5%. Maybe on the aggressive sell side estimates, it gets up to like 5-6%. So I really don't see the story here. You could make the argument they'll raise prices because they have branding power. I don't really like the setup. The setup isn't ideal. We like to talk about, when we see opportunities, what's the setup? Is the setup poor? Is the setup great? If the setup is poor, then that's making the statement that everything else has to go right in order for the investment to make sense. Either you have multiple maintenance plus growth, and then that's your return, or you have multiple contraction on the other side. But in the case of many other opportunities out there, you can have multiple expansion. For example, you have Crocs. Crocs had a multiple contraction, then followed by multiple expansion. So a lot of the returns this year, and Crocs has done wonderfully, was that multiple expansion from a low base where it was in the single-digit multiples and then expanded into the 12-digit multiples plus the growth that it had. Now, if we're getting into the conversation about options, we can talk about some of the ways I played Crocs. So I played Crocs by buying the comments. I also played Crocs by selling puts. By selling puts, I'm also being directionally bullish the stock. And then as the stock continues, the puts actually will decrease in value, and then the rest is my profit. As of now, as of 2 days ago, or it was yesterday before the close, I was able to close my puts for Crocs. And so currently I have no puts for Crocs, but I'll tell you a scenario in which I will reopen these puts on Crocs. If we see Crocs report earnings by the end of next July, which I believe they report on the 25th of July, if some of the data points that are coming in are correct and they might miss earnings, maybe, then we will probably see another opportunity to either sell some more puts or buy more comments. In the case, I'm not selling my comments because I don't want to create a tax consequence, because yes, taxes matter. So, and I don't want to play with the SILT. It's done well. The thesis has worked out, and it could end up becoming that no, the data is baloney, and we're going to have still a good quarter. And really, I'm paying attention to Hey Dude as the main KPI that's important as far as fixing that. The most impactful KPI is going to be the performance of Crocs itself, because that has the highest contribution margin, not Hey Dude. So Hey Dude was the blunder that gave us the opportunity. And then you also have the Crocs, which has, again, the most important part or most important component. So if Crocs, the brand, does better, then Hey Dude, it's kind of irrelevant. That's what happened the last couple quarters. But it's not that Crocs is even a big position. It's kind of like a fun side quest of sorts. Oh, it's the guy who commented on PayPal. That was really unfortunate, dude. But if you think about it, one of the guys who's always the bottom signal, he was bearish on PayPal. So you have that going for you. Maybe it has bottom eventually. Okay, but yeah, that comment was really badly timed. It was unfortunate. Do any questions about Under Armour? I haven't looked at Under Armour. I don't think so. It's just It's a tough business. Apparel's a tough business. You have Lululemon that also looks somewhat interesting. I have no position. I know club members who have a position in it, but I haven't decided whether or not I would like to stake a position in it. And I think I saw someone talk about no one talked about some of the others. Okay. So if you're talking about, I think I'm remembering the live stream from yesterday, but yeah, you have a bunch of apparel businesses like On, and of course, we talked about Deckers. So Deckers is growing at a nice clip. It's growing roughly 30%. And you have, again, a multiple in the 30s. So it checks out. It's fine. It's not screaming value. Maybe you could have argued it was screaming value 40% ago or earlier this year. Same thing with On. Again, you can make the argument the brands aren't as strong as Nike. That's fair. But Nike is not providing you the growth. Nike is just a bunch of retail investors who are just going to be like, Nike, the brand is strong. And what your upside is here is the market decides, hey, we're going to expand the multiple again. This deserves to trade at 30. Not at 20, because you're not going to get it from the growth. So there's not going to be growth plus multiple maintenance. It's going to be either multiple expansion, or maybe they pull something out of their hat next year and there is growth. That could come from a variety of ways. Primarily the one that comes to mind is you have Asia recovery, or you have price increases. And price increases, of course, the consumer has to not reject those price increases, and that would be more of a testament to the strength of the brand. That could happen. I wouldn't bet on it though. It just doesn't seem like it's a solid bet, so to speak. So not something I'd be focusing on. All right, let me check on the time. Okay, so we can talk about CXW. We're right on time. Okay, so Core Civic. So Core Civic's one that was interesting. I'm talking about it now because the play is already played out. So this one was pitched in the club not even too long ago, and recently what happened was quite an interesting conundrum. So they lost one of their contracts back just now, like just not even a month ago, and the contract in Texas. There's a few key details. So the contract in Texas was, first of all, always meant to be temporary. It was done under emergency scenario under the Obama administration. So if you looked at the terms of the agreement, they were quite unfavorable relative to other contracts made around the same time, or not the same time. In the same time, but in other jurisdictions. So if you had to do a comparative analysis between the contracts. And so if you had looked at that, you would have seen, okay, this is probably not going to be a forever contract. So in addition, the contract didn't even make up that significant portion of Core Civic's top line. And so when you actually made the adjustments, the sell-off didn't really make too much sense. And on top of that, their guidance for growth was basically the rest of the system is going to relatively absorb it. So I viewed it as an interesting opportunity, and there was one way to play it: a bastardized synthetic long. And so the way you can do that is you sell it and you buy a call, sell a put, buy a call. So that's what we did, and then we're up on both legs. So this one was interesting. This is part of the title of the Trump pump. One thing that I didn't foresee was the debate. I'm not going to get political or anything like that. I'm not going to make a political statement. All that I know is that right now, today, the market looked very favorably on all the private prison stocks. And that boded well for us, especially because the contracts that we had, specifically the calls, and I'll talk about what the durations are. So for the puts, I sold the puts at a $12 strike for expiring in August, and then I went a little farther out in the calls in December. And so what that basically did is that the puts are having a faster, much more rapid decay through theta decay. And as, again, we're directionally correct, that's also having an impact. And then the calls, now they're well in the money. So the duration is giving us a lot more flexibility, and we can kind of get closer to election time. So I think those are going to do really well for us. And then those other puts are going to expire worthless, very likely. And I can more than likely close them ahead of time. So yes, they are. I don't think they're dependent on politics. This is the part that I think is kind of strange. So, but I get the thought behind it, Moxie. I completely get it, because that's what a lot of people think. And how do I know that? The reaction today. So the reaction today just tells me that the assumption before, and there's a pitch in the club about private prisons being one of them is focusing on the sentiment trade around politics. So if, for example, you have a Trump victory, you can bet that these companies, even though nothing will change as far as the economics goes, the sentiment's going to improve, because nothing has really changed across administrations, whether it's the Obama administration, the Trump administration, the Biden administration, and now whoever, whether it's Biden or Trump again. So nothing will change. It's just the sentiment, the perception, and then the implied multiple that you might get right after or post-election. So the implication, and you can see this is definitely the case behind today's rally, because it's not a coincidence that after the debate last night, and then you also see the changing in polling, you also see the changing in gambling data around the election, simultaneously or just coincidentally, all the private prison stocks rallied the next day, because again, the sentiment behind a Trump victory has improved. So I take it as like, okay, this is kind of silly, but I'll take the victory. And I don't know if I'm going to necessarily take profits early, but right now the calls are up like 60%, and then the puts are up about 50%. So again, the reason why I say the puts are up 50% is because I sold them. So I'm on the other side of the trade. So then both legs are doing fine. Okay, so we're good on time. And so I'll kind of open up for any questions on this topic, on the prisons, et cetera, the contracts. Let's see. It's local. Most prisons are state, not federal. Absolutely. That's also true. And that's the other part that doesn't matter for the administration. All right. Do you ever think BABA will recover? Yeah, I can answer this. So let's do BABA. All right. So Alibaba Group. The thing with Alibaba is, if you're buying this, I mean, I have too much content ranting about the efficacy of investing in Chinese VIEs. So long story short, I think it could recover if sentiment recovers. Does that matter for me? Absolutely not. I do not care. I view this all as pieces of paper, but I acknowledge that the rest of the world may not see it that way as myself. So I'm not going to cry about it and fight the world. The rest of the world looks at Alibaba as a legitimate business, a legitimate ownership in a business. I disagree with that vehemently. And because of that, I will acknowledge that they can be proxies for a particular trade. What is that trade? I believe that you can play a change in sentiment towards China. We improve our relations with China. There isn't going to be a conflict. All these things bode well for China. You want to play the Chinese economy. I feel, that's my opinion, as though you own, well, I know you don't own anything, but I feel as though it's not worth the risk. That's my opinion. That part's my opinion. And that you're taking on way too much risk. However, I will acknowledge that if you were to invest in Alibaba, there are times and moments that you can make a good amount of returns based off of sentiment shifts. I will point out to you the allocation of capital, or the return of capital policies by Alibaba, indicate that my prior concerns are valid, in that you own nothing. So I've talked about that in prior live streams, but not to get into it too much, because I want to be punctual with time. But I do have about 4 minutes, unless there's another question that someone wants to answer. But if you look at Alibaba's convertible note debt offering, well, JD's, and then Alibaba, I think, pursued it afterwards. They are in a position where they don't need any capital injection, and yet they're pursuing this. So it's a bit problematic in my view. That they're doing such a thing without the necessity to. And that sort of shows me that more than likely they're viewing the Western investor as a piggy bank. So yes. Baba is risky, but Gazprom isn't. Okay. No, Gazprom's extremely risky. I don't know where you got that. But Gazprom, you actually owned the shares. That was a big difference. So Gazprom's extremely risky, though. I don't know where you got that from. Let's see. Howard Marks owns Baba. Yeah, I don't really care if a super investor owns anything. That's how you know I don't follow super investors like that, like a religion. That some people do, and that's to everyone's detriment if they don't do their own research. Bought a position in Salesforce at 230.15. Do you think this is undervalued at these low prices? I increased my allocation to Salesforce at the sell-off, yes. So we're going to talk about CCL. I'm at the 40-minute mark. Don't worry, James. Don't worry. We're going to get there. But I'm going through questions while we finish up these, and then we'll get to CCL because that is the next topic. Let me make sure. Oh, that's a big blunder. So what we're going to do is we're going to switch them. I did an oopsie. So hold on. No, you guys are right. That's why you guys were asking for Carnival. I was like, what are these guys doing? There's a strict order to things. Okay, so I changed the description. If you refresh now, the correct timestamps are in. So we're going to talk about it. So let's see. Chinese stocks within 10-foot pull. Absolutely. Yeah, I wouldn't touch them either. And that means they don't understand the VIE structure. When someone says that they can just buy the Hong Kong shares, they have no idea. They haven't done the research into the VIE structure, that the Hong Kong shares are part of the VIE structure. I know that Barn Wuffet, you've probably seen all my content, and you're probably just guiding me through the talking points because you're wanting me to bring up the points. Because it's almost like rehearsed, because it's like you know exactly what thing to say. But yeah, if you say that if you just buy the Hong Kong shares, you that person, in the case Everything Money, thank you for pointing that out, because Paul knows nothing. It's like really bad. And by the way, Paul beats every other YouTube investor as like the worst investor by far. Yeah, like by far. Terrible. Like no one, and that's something, by the way, but no one, like he's worse than probably, I think he's worse than Stockmo at this point, because his degenerate gambling on Nvidia, I think now has him at the highest loss, where I don't know how he's going to recover from that, besides maybe daddy's money. I don't know. So, but yeah, he doesn't understand the VIE. And so, I mean, he doesn't understand a lot of things. For example, he got wrong how to calculate the intrinsic value of bonds, which is a very, very elementary, calculation to do. Strongman Personal Finance did a great video about that. I might have had a video about that. I can't recall. But yeah, he didn't calculate bonds correctly. And that was a big oof. But he didn't even know that 3M had a lawsuit, on and on and on. I tend to avoid anything he buys, personally. I view him as actually a good barometer, whether or not I'm being a moron for a stock. So that's a little bit of a hint to how to get some good avoidance of bad companies. Oh, that's a great question. I wish I had one of my analysts on with me, but I'm not the fan favorite, or not the fan favorite. They're not like my bread and butter, but I do have exposure to private equity. So yeah. 3M. I haven't looked too much at 3M to have an opinion, so I'm sorry, cop out, but I don't want to give you an opinion that's not well fleshed out. All right, so CCL, the people want to ask about CCL. So Carnival Cruise. So I had Chris on the channel. He's a friend of the channel, and what we talked about, he originally pitched Carnival Cruise. He was nice enough to walk us through. I liked the pitch, and so what I ended up doing is the day before earnings, I also did a bastardized synthetic long. And so what I ended up doing essentially is I sold puts really long dated out at December 2026 at a strike of 17. And then I took the premiums and then I purchased calls at a shorter duration. And that shorter duration allowed me to capture more of the upside if I was correct. And so I was pretty confident, based off of the data that I had seen, based off of competitors, that the earnings data was going to come out positively. And so what was that earnings data? Well, more specifically, the KPI that was very important was the passengers. So if we saw passengers expand and we saw them increase, then we would see the rest of the things fall into place. We know that the CapEx was eventually going to come down, and with the finishing of the island, but that's further out into the future. So all these other things are yet to play out, but the market's going to reward Carnival ahead of that, because the market's not stupid. The market's forward looking, roughly 12 months out. So the point with that is you can capture all the upside, and in fact, you don't cap your upside, and then you can do so in a very interesting way where you grab the capital roughly from thin air. and you can generate a pretty solid return. Way too much dilution on CCL. Well, I tend to see Eric as like, okay, what was the past? Yes, it was bad dilution, but contextually, what did that mean? Well, you got to understand that they were going through a period of time where the world was shut down, and so you had they had to survive somehow via debt issuance, share issuance. At some point in the future, there's going to be some buybacks. I didn't want to commit, let's call serious sums of capital from my, let's call it the actual portfolio. But I was willing to commit capital via options. And so the options play allows me to minimize my downside, but capture most of the upside of whether or not I would have put an actual sizable amount of money from the portfolio, from the equity portion of the portfolio. So, hey, it's a long time no see. I remember you. Howell, how are you doing? 2 nights in a row. Yeah, I wanted to come on because I didn't get to talk about all the other topics that I wanted to today. So this one's more of a focused on the topics that are listed in the title and the description. But yeah, if there is any questions on CCL, I'm more than happy to go over those with you guys. So any stocks or options anyway? Oh, well, now if you're asking these questions, these are the great questions, but I think you're making a statement actually. But yes, this is the general premise. But I encourage you, because you are a viewer, Gil. So I will tell you, as I would tell any other viewer, the yield max funds are a waste of your time. I would praise you more for buying SoFi than I would for buying yield max. Well, geez, actually, I don't know. No, I can't be that stubborn headed with it. SoFi is pretty bad. But there are some yield max funds that I would say are SoFi is better than them for sure. But no, there are some that, because SoFi is that bad, or that degenerate. Okay, so I'm not going to get into SoFi. People hate it when I get into rants on SoFi, but yeah. What strike prices did you choose? Oh, I thought I said that. So 17 for both. The durations were different though. So let me repeat that, but good question. So Carnival Cruise, the strike on both legs was $17, but the puts were long dated. So you get the most premium, and they were for 2026, December 2026. And then the strikes for the calls was for October, and the strike 17. So same strike, different durations. So a bastardized synthetic. I will admit, yes, AMZ is better than SoFi. No, absolutely, because the underlying is so good. That's the thing. But I do not want you to mistake that I am endorsing AMZ. No. There's no reason to buy AMZ. Just buy Amazon. Just stop. Don't make it complicated. Just buy Amazon and call it a day, and your portfolio will be happier. And if you're right on the directionality of Amazon, your portfolio will be happier if you picked Amazon over AMZ all day, every day. It is interesting, and I want to assure Hal, you're in the club. So it's not the vast majority of capital. It's it's a sizable amount of capital, but it's not the vast majority. Yes. Okay. A gentleman's agreement. I will apologize to you if over a 5-year period, because it needs to be 5 years, over a 5-year period, Amazon underperforms AMZ. Gentleman's agreement. I'll apologize to you because I'm fairly confident in saying that. Okay, let me see if there's getting added. What am I getting added for? Okay, I'll address this later. What if the stocks goes down and you're in the money on CCL? What if the stock goes down and you're in the money on CCL? Well, that's the question that I'm contending with right now. So for this question here, I'm contending with, do I close the position now? Because the duration is until October, and the gains have already been, pretty good. I don't think I'll have to close, or I don't think I want to close the puts, but I could close the entire position come Monday. fair enough. And because the returns just this week were really good. In fact, I might end up showing you guys the returns. Actually, like this week alone, there was I think we experienced a improvement of about 10%. Yeah, like 10% alone this week, but that's in a mix of multiple positions. That's not just the options. It makes it sound, based off of me answering that question, that it was just the options. It was not. It's not that crazy. Got a letter from a bank to join an options course. I mean, yeah, if it, okay, so I don't know what good it's going to do you besides, you kind of trying it out yourself, but I'm very careful about encouraging it. And so some members, or some viewers, I should say, they maybe took that as I'm trying to gatekeep options. I'm not trying to gatekeep options, but I'm trying to make sure that they're respected. So you should respect them, not think it's your ticket. So yeah. Oh, you're saying it's a new low for the banks to offer you. Yeah. Okay. That's fair enough, because I think that in mass, it's not a product that should be used in mass. And like what I was making the point of the synthetic covered call strategies, I think that they have no place in the investing world, and they should be, regulators should really take a hard look at that and ask themselves the questions. What is the purpose of this? What is it trying to do? What is it trying to attempt to achieve? Is it providing any sort of meaningful value? Is it providing alpha? It really isn't. Who is it targeting? It's targeting people who are less fortunate. Should we allow this product? Okay, so we have this, but I want to make sure that we're getting into the next, or the final part. All right, so I will be posting actually the most up-to-date one tomorrow on Twitter if you're curious, but I'll show you guys this one right here. So I posted this today. I do this more regularly within the club. Okay. And let me go ahead and post the one that, because there's a reason why I did 2 different updates, because it was actually crazy. I didn't expect this to happen, but it did. Okay. All right. So year to date is all that matters. I'm just kidding. It doesn't matter whatsoever. Hey, well, it's fun to talk about. But I already updated you guys at the end of last year what the performance was for 2023. Spoiler alert. It was decent. We did pretty good. And then this year we've done even better. So last year was 65% performance. And so this year, this is the performance as of a couple days ago. There's a reason why I'm showing you this one first, because it actually gets pretty crazy. But based off of the performance of some of the investments we had this week in particular of this year, and we're 6 months through the year, was pretty astounding. So this is the full performance now. And then this is actually going to be a little bit higher tomorrow, because we had a decent day. We didn't have as good of as a Thursday. Thursday was amazing. But so in Thursday alone, we saw pretty outstanding performance. So this is up to date as of the Thursday's performance. So it's, again, you can see there, June 27th. Merrill doesn't update until the next day. So on Saturday, I'll get Friday's performance in there. And then my CAGR doesn't update until the end of the month, because Merrill calculates CAGRs at the end of the month. And my CAGR, I have, I'll show you guys my CAGR too. And by the way, the portfolio is updated, dollar figures and everything, only for the club members. So they see the portfolio screenshots and all that. You guys can just guess. Okay. Oh, let me kind of zoom out, because that'll be like a little too wonky. All right, and then so this is the CAGR so far that we've been able to achieve. Again, the year to date isn't obviously up to date, because you can see the date at the top. This updates at the end of the month. So when we finish June, this will be updated. And so the CAGR will obviously be higher, because the year to date will obviously be higher. And so you can see the cumulative portfolio CAGR, and you see it's annualized is 43.49%. NASDAQ composite annualized has been 6.77%. over that period since we started Capital Mindset Holding Co., which, I mean, the account was started before we started doing videos and stuff, and I never even intended for the holding co to be used for this purpose, but you know, it's now is what it is. So yeah, I can probably, well, there's not really going to be a point. You'll probably get another update at the end of the year. But you know, club members, you'll get the annualized update or the CAGR performance update at the end of the month. So you'll see the June figures. Is this a real account or paper? No, it's real. It's completely real. It's updated quite frequently and regularly to all the club members. And again, they're all watching. They can attest to this. They definitely be calling it out if it was fake. So we've been really lucky, blessed, whatever you want to call it. I like to think, you know, we've made really strong investments. So when we think we're right, we bet, or bet is the strong word, but we invest heavy. So, and the vast majority of the returns has been through common stock. Yes, it includes options. Yes, it includes actually fixed income. I should note that roughly 15% of the portfolio is fixed income in preferreds, municipals, etc. So, well, actually, I think that figures. Let me see. I can probably do the. Let me log in and I can actually do the portfolio X-ray, which I think I'm going to have to do some shenanigans to cover up the dollar figures, but Sam Veers. Okay, so Sam, he records everything in the server. He's our cameraman. And he is, so if you guys don't know, his face right here, there's a big meme to it recently. I don't know if I should explain. I can't explain it to you guys yet because I have to finish the trade. And I told Andrew, once we're done with this investment and that pitch is finished, then we will do a public live stream talking about it. Because I mean, there's a reason. We don't want to affect the price action of the stock. So everything that we do, has to be legal, has to be by the book. We just have to be careful, abundance of caution, really. And then also kind of thinking about the members and have them having, you know, privy to the information. And then we can talk about it as a case study. That's a lot when I'm talking about the Carnival cruise investment, the way I did it, why I'm talking about it now. It's an interesting case study if you want to think about it from an academic standpoint. So, all right, let me see if I don't find a quick way of just hiding the dollar figures. I don't even know why I might even want to hide the dollar figures because people know what they are. So I have to go to, oh yeah. Where's portfolio X-ray? Current account holdings. Oh yeah, portfolio analysis and allocation. I think I can just do asset allocation. I don't have to do the full X-ray. Okay, so, oh, I can just do this. I can just take a quick screenshot and I just leave out the dollar figures. Don't have to show that. All right, how am I going to do this? I can do I'm going to do some shenanigans here of this, and then I can just open image. Oh, it's so zoomed out. Okay. So this is the current allocation. Gives a good perspective on it. So equities 83.92%, fixed income 16.08%. Yeah, nothing crazy. Fixed income makes up, I just stated what they are. It's municipals. So municipals, if you guys want to know, if you guys care for that stuff, it's really riveting stuff. But I hunt for municipal opportunities, and so that's tax-free bonds because yes, taxes matter. And then CDs make up a certain portion of it, but I don't increase the CDs past a certain amount. And then there's also the preferred stock opportunities that are also interesting. Those I actually hunt for. So, yeah. Well, thank you, Hal, for the nice comment. To be honest, Gil, a free course is takes a lot of time. I just frankly don't have. I would not put out a subpar product. And unfortunately, it's just because it's a time constraint, Gil. I apologize. I try to make myself, but conversely, as available as I can on, other Discord servers that are free to access. And people at me in other Discord servers all the time, and I answer questions within the realm of reason as much as I can, and that's counting as free interaction. I don't refuse to discuss with people just because I'm pretty accessible. Now within reason, because there's a lot of the times of the day where frankly, if I'm busy, I'm busy. It is what it is. Call it Hamilton ETFs, just like Yield Max, same garbage, different pile. Yeah, I mean, well, I use Yield Max because it's very popular. It's discussed a lot. So Fabi just buying Moonies. JC, you know why. I mean, I'm trying. I have fixed income, and taxes are a big problem. So if there's any questions, I see $1 portfolio with max leverage, the club to find out. Yes. That's always the joke too. It's like, for all it's $1,000 portfolio to the $1 portfolio. Oh, so I see it's the Canadian version. Ooh, even worse. It's monopoly money. I'm joking. I love all my Canadians. We have a lot of Canadian members, and I'm working on my pronunciation of alimentation custa. I didn't even read Sam's comment. Generated in the Matrix by H. I didn't read that part of the comment. That's amazing. Just back tested their HMAX, and the common stock massively outperformed. Canada's trash. Don't worry, Fabio. All right. Well, I didn't say it. Let me pull this up. What is the ticker? HMAX. Ew. It has Canadian financials. Oh no, it's the most Canadian ETF ever. Is this banks? This is the most Canadian ETF. When I think Canadian ETF, this is like the epitome of a Yield Max if it was Canadian. Is this banks? No way. This is banks. Please respond if this is banks. If this is banks, this is hilarious. There's no way. It's banks. So for anyone watching, if you're watching from any part of the world, the Canadian investor has an infamy that they like banks. Oh my gosh, I just realized. Do you know what oh my gosh, so like the meme has just multiple layers. It's just hilariously pathetic. So okay, Canadian investor is like obsessed with banks. So then you look at the YouTube universe of investors and look at the Canadian fintech guys. They're Canadian and they're into growth stocks. What is their favorite stock? Think. I won't say the answer. Come on, think. It's obvious. Their favorite stock is, I know there's probably a delay between me and the chat, but it's ends with Wi-Fi, rhymes with Wi-Fi. Andrew, you called me an animal. By the way, I also wanted to shout out. I showed you my performance. Andrew is one of our analysts. He's also done incredibly well. As part of the performance review tomorrow that I'll be posting on Twitter. So you guys get it at first, even though I promised Twitter first. I've just been busy. So I fell a little bit of a foul of providing it on Twitter first. So you guys get it first. Or actually some of you are watching this on Twitter. So if you're watching this on Twitter, surprise, right? This is the time. But Andrew, I'll be posting his performance as well. And because he volunteered, it's not personally Andrew. He volunteered and he's been doing really well as well. His CAGR is also very impressive. So, oh, you know what? I completely forgot to send the link to, just in case some of the guys want to come on. I completely forgot. No pressure, by the way. You guys watching? No pressure. All right. I thought I sent it out. It's my bad. The Gary analyst pay raise for good performance. Right now, because there's not like a CM fund per se, but no, that's not out of the question. That's definitely not out of the question because, I've toyed around with the idea of kind of doing something along those lines full time. But I don't know what that would mean for YouTube, unfortunately. But it is what it is. YouTube, it's very fun. I love talking to you guys in front of the camera. It's almost like therapeutic of sorts. But it's not very. If you think about it from a financial standpoint, it's not crazy. So, but made a lot of great connections. Got to meet a lot of people. The club is frankly amazing. I have a ton of fun talking to people in the club. It's a lot of interactions, a lot of people from different backgrounds. And by the way, I should start stressing that. So if you join the club and you have some sort of expertise, it's probably the right fit for you. And if you're a person who likes to do collaborative work, I do not encourage people who join, and this is like a warning, do not join, or I discourage people from joining who want to just copy trade. You can probably find the other YouTube scammers who can go and you can just do whatever they do on their courses, buy their 10x course and stuff. We're trying to be a club. I'm the figurehead. And there's a lot of really smart people who work in various fields. They share their research. And it's a collaborative effort to find different ideas. I'll do my best to find ideas. Andrew will do his best. Leo will do his best, on and on and on. But it's really meant to be collaborative. So if you're watching this and you were thinking about joining and, kind of just copy trading, etc., I would encourage you or discourage you from doing so, and then maybe point you in the direction of every other place. But if you're looking for just collaborative research and you have some sort of you don't have to have an expertise. I'm making it sound like it's some like gatekeeping. I'm not trying to gatekeep it either. But if you're coming with like a mindset of you want to learn and you're going to ask questions, you're not going to just say, what do I buy? That's the right mindset to have. Capital mindset, hey, it's the whole mission. Okay. So, but yes, I would invest 500K in Fabio's fund. Hey, well, if you're a accredited investor, that could be something in the near future. And I'm working on, because thankfully I can be financially independent. We can be extremely cheap with the management fees, so we can revolutionize this. But I've been talking to some of the members. All right, so hello, how are you, Bacon?
I'm here. How are you?
No shameless cloning. At least have some shame. No. So like, if you're curious about the idea and you're inspired and you like the idea, we don't discourage that. We're like, hell yeah, you like the idea, you like the idea. What we don't want is someone going like, let's say Bacon here. Bacon tells me, hey, Fabio, I'm buying Crocs. I'm like, oh, cool. I buy Crocs. That's what we don't want. Bacon. No. The idea is Bacon says to me, hi, Fabio, I'm buying Crocs. I'm like, oh, what's Crocs? We walk through. Yeah. Do an evaluation. We collaborate. We look at the financials together. He finds something. I find something. We put the thesis together. And then he comes out of it. I'm going to buy more Crocs. I come out of it. I'm going to buy Crocs. And I'm kind of actually playing out somewhat how it went, because he bought Crocs before me. So,
well, I mean, but to be fair though, they're like not my original idea, and other people in the club have purchased it before me as well and shared it. So it's nice, but it's also not only like one gigantic sort of like circle jerk, for lack of a better term. Like, people give each other a fair amount of pushback, such as, hey, have you considered changes in the industry? Have you considered why they're treating accounts receivable this way? Why have they done this, that, or the third? It's really nice. It's really nice. Like, you'd get great ideas and perspectives from everywhere.
And as much as anyone, a lot of the I can attribute much of the strong performance this year to the talented individuals who, I have conversations with almost on a nightly basis. Tell me I'm wrong, Bacon. Nightly basis.
That's pretty much true. If not multiple times in a given 24-hour period.
And the amount of people that we're making it sound like an advertisement. We get to the topics. We have other things to talk about.
Yeah. Anyways, I think you've been sitting on Builder for a while.
Yes, I'm so sorry, viewers. I'm passionate about the club, and so I can talk about it all day. I brag about it. Yeah. Okay. We have a lot of stuff. We have Costco. Someone asked me something else. Oh, here we go. Diageo, because I saw like you asked this a little bit. several times, and so we'll talk about Diageo. So we covered this actually within the club a while ago, and I will repeat or parrot what one of the analysts said. And you know who that is? That was Leo.
Leo, yeah.
Yeah, so Leo never comes on publicly. So you guys don't even know who he is. I don't think he's ever had a public appearance.
He's a cat with glasses.
Yeah, he's a legitimate mythical cat with glasses. And what we basically came across or concluded is Diageo is going through a inventory problem. This is known. And the inventory problem for high-end alcohol can take years to correct itself. And so you have Brown-Forman and Diageo. Now, the caveat to that is that the market will reward Diageo ahead of the actual correction. So the correction in Diageo and Brown-Forman will occur prior to you seeing it in the numbers for inventory correcting. Now, when you're looking at Brown-Forman versus Diageo is undoubtedly cheaper. If you look at the brands, I think that's up for debate. Who has the better brands? The reason why I'm bringing up Brown-Forman is because I'm trying to bring up an alternative in case you may or may not have been aware, but I assume that you were aware. And then in case other people watching are also weren't aware, now you're aware. Brown-Forman, Diageo. There's a couple others out there. Technically you can get into Constellation brands, but it's not a strong contender. So I guess the turnaround play here for Diageo, it looks cheap, and I've mulled over it at least several times. At one point, I owned it for a very brief time before as a watcher position and basically concluded, okay, not yet. I'd have to relook at it hard and determine if we're closer to the bottom or correction, but kind of with that same understanding that the correction can take years for it to happen. So it could take 3 to 5 years sometimes for the supply chains, the inventory to correct itself. But again, market could be rewarding it well ahead of that. So, all right, we can get away. So have fun. All happy con day.
Oh, just tips the hand right there.
Okay.
Thanks, co-host.
Well, no, Gil, you should. I'm going to correct you there. Just so you are aware, Uber was an investment. It was pitched by one of the analysts, and I invested in Uber. The analyst invested in Uber, and there are actually several Uber shareholders within the club. So not true. You were shut down perhaps in the live stream, maybe in the live chat. But again, there's a difference in the live chat experience, etc. I don't know what to tell you, but Leo, the other analyst, he is still or actually, I don't know if you've already exited Uber. Did he exit Uber?
I honestly forgot.
I can check his portfolio because, like I said, when you the club members, they get access to my portfolio and the other analyst portfolio, so I can just check Leo's portfolio.
Yep.
All right, let me check. Does he still have Uber?
Because his last upload was somewhat recent.
Yeah, no, he doesn't have Uber anymore. He already sold Uber.
Yeah.
Yep. I think he sold Uber a while ago because I didn't remember. Yeah, because it wasn't in his sell list. So his sell list, he had. Oh, I'm not going to say. But he sold 2 stocks, and neither of them was Uber. So he sold Uber updates ago. So I must be not as up to date. I'm trying to find. Well, I'm spending too much time. I'm going more updates up, and I still don't see it. So yep, he sold it a while ago.
It's fun seeing Leo's portfolio management, though. I will say that much.
Yeah. So he has. Well, I don't know who has more churn. Maybe as a percentage of dollars, I think he might have a little bit more churn than me, but yeah.
Maybe, but like even then though, whenever he enters, it's usually, unless conviction's high, modest percentage. Same with you. Same with many people, but
yeah. No, shout out to Leo. I know Leo's probably busy right now, so he's not watching this, but yeah, here you go. Sam's giving you a compliment. Sam, you know what? You should tell Leo, just at him. Just tell him that. He'll smile a little bit. He'll be like, "Oh, thank you."
He'll be a happy cat with glasses.
Yeah. All right. So, would you ever sell Meta? That is a great question. There is a price, presumably, that everything is for sale. Oh, wait. Let's conclude Diageo before we move on. And there was a question on Builder, but don't worry. I'll answer your question on Meta before we get to Builder. So Diageo, I would probably personally, I think I'm going to wait to my own detriment. But if you think it's a good buy right now, I think you could do worse. I think Diageo is a quality business. I don't know what the value would be that I would get in off the top of my head. I'd have to really look into it, do my own analysis, build out my DCF, and go from there. Really look at what the industry is doing, how the inventory doing, and if I see signs of correcting, I might go talk to someone who I know works in the industry, ask them, converse with them, figure out how's it looking, and then from there come to determination. But surface level, what I knew before and what I know now, which is limited, I think you could do way worse. But yeah, and I see someone said no growth. It's no growth now because inventory. That's the context. You're missing the context there. And the market will reward it always before the correction of the inventory. So if the inventory is corrected next year and things are actually better than what people anticipated, you'll see it gap up. You'll see it re-rate just because it'll be back. All right. Anyways, do you recommend relatively new investor join the club? I just want to listen and learn. Only been investing for 3 years. I think we have people from all walks of life in terms of like what their experience levels are. You know what? Because I feel like I'm biased in telling you that. I will allow the club members, if you guys want to say if this person should join or not as a newer person, feel free to do so. But I guess because I feel like I'm biased in saying that. I don't know, Bacon, do you want to say anything to that?
I definitely am biased as well, but that being said, though, I imagine so. Like how there's newer people that I've interacted with that have asked me everything from specific due diligence on a specific company or industry to broader topics like portfolio management. And we like don't ask just one person. Like, and hopefully, to my knowledge, people don't ask just one person. Like, they don't just zero in on you, Fabio, or other analysts. Like, they also ask other community members. And I am very confident that those with working brains, and there's a fair amount of them, they'll just quietly watch people's pitches and ideas and just sit on the sidelines before they make a move, just to like mentally take note. Oh, this person has what seems to be a good track record, or oh, this person swings and misses often in this industry, but maybe in another, given enough time, maybe. So it's a lot like other places. Like the quality may vary. Not everybody's perfect, but you know, there are definitely different styles. By the way, it's not just only value or only growth or only momentum.
Definitely for the context of Hal's question is because there's probably hundreds of hours of content.
Yeah.
Hundreds. I'm not exaggerating.
Mm-hmm.
Because think about it this way. Every week there's 2 live streams. Sometimes there's only 1, but 1 to 2, most of the time 2. And each one, it can be 2 hours long, easy.
Yeah.
And think about how many weeks there's been. There's also Sam Veers, who I said right here. He is the... I'm not going to pull up his sex symbol comment, but
please don't.
I'll say this. So he is the
I'm
cameraman,
not.
and I mean, he records every conversation. And so, and he very nice to like, I don't know if he timestamps it, but he titles them. And so, yeah, there's quite literally probably you probably don't have enough time to consume it all. But I think Kale's point here is also valid. Another member says join and try the club for a month. Just make sure you're active in the voice chat. I think most of the value is in the voice chats.
I'd say
For
so.
sure. A lot of it is. All right. So the question builder, and we saw Disney. Ooh, Disney. I was just looking at Disney. I was talking to Boomex about it today.
Oh, well, was Boomex bearish or bullish?
Oh, he's asking me if I'm going to re-enter Disney.
Oh.
But first builder.
Yeah, because if Boomex is bullish, something that's interesting.
Yeah, I know, right? Boomex,
Yeah.
if you're watching this, every time you tell me you're bullish on something, I go like, that must be very bullish. because it
But
takes
yeah,
a lot
Builder.
to get them to be bullish.
Yep.
But yeah, Builder.
Good old Builder.
Well, Koji. I just saw Koji's comment. Look at the Koji.
No, good old out Koji.
Do you like options, SoFi plus PayPal? Yes, that's actually all we invest in. That's how the returns were achieved. I buy SoFi, PayPal, and I do options on them. I do with the wheel strategy. Oh, the wheel strategy. Jesus. All right. Anyways, so Builder's first source. BLDR actually at one point was a pitch that was abandoned very timely. Very proud of that. And now we're at just under $140. Has bought back tons of shares. I will give them credit to what members kind of pointed this out to me. They did not buy back shares at the high prices and has historically been a share cannibal. The question really just is, how do you feel? And Bacon, not a rhetorical question. How do you feel about construction?
Rocky for now. That being said, though, like definitely one to keep on the radar. Maybe the bigger picture, the longer term, works out. But right now, it's shaky for sure. Because Builder, you're worried about multifamily and single family, and multifamily with the most recent earnings call showed signs that it was not good. And recent housing data has indicated single family in U.S. not great. But long run, if you're okay with the stretched timeline, and fairness to Dan, like credit to Dan, that's who pointed that out, and I think it's a reasonable assessment. So maybe this is one worthy of the radar if it gets to a price that you find attractive. What the right price is, I defer to you, the viewer.
Precisely. I mean, for me, I'll tell you what I've done. I have no common stock right now in Builder's first source, but I do have a very small put option position. And to be clear, it's not purchased; it's sold, so it's directionally bullish. And the strike price is at $110 at a duration of 1 year out. So we'll see how that is, because I determined that $110 for me is fairly attractive. But remember, I don't view the put option strategy as the way to get exposure to a stock. No. If I like it, I'll go along the comments. Right now, I'm grappling with other opportunities. There was a topic that I'll bring up, and we talked about it in last night's stream. I have the problem right now, and Bacon's about to know exactly what problem I'm about to say, that I have the problem, not that I cannot find opportunities, that there are too many opportunities. So frankly, the thing I'm struggling with, and I talk to this with the members all the time, it's like a mental struggle. I complain about this a lot. Because it is a real problem. It is, because you get distracted if you find too many things. And it is a game at the end of the day about which one is the best one. So it's a beauty contest, but not in the beauty contest to say it's like, you fell for the pretty one. No, it's a beauty contest of like legitimately which one is the more attractive opportunity. Yeah, it's tough. It's tough, especially when all the opportunities are, many of them are just as beautiful when compared to each other. So sometimes I will elect to express a long position via options in an effort to kind of gain exposure to the idea without committing serious amounts of capital. So, but yeah, Builder.
Say you like it, maybe not enough to put in serious money behind it right now. For now. For
now. For Alkoje, I'll shout out VKTX for him. We'll talk about it.
We're like, does anyone short VKTX? Honestly,
no. So the joke, there is like a small, I'll warn anyone. There is a small VKTX cult within the server.
Yep.
It's we all have fun in games. We bust each other's balls, but the joke is, well, I would have done well. I should have shorted it. Look at this.
If only you did.
Because when they were like begging me to buy it, it was like, here. Look at this. If I shorted it, 33% free money. Look at that. No, I'm kidding, but I wouldn't short it. So So we're shouting out BKTX just for you. Which children am I going to keep? That's always a tough decision. But we saw Disney and well, anyways, Builder. I probably would consider buying Builder if I was more confident on where construction was going to go. If I knew where single family was going to be, I think Builder right now is good. So I'll say it to you. I'll put the question to you. How do you feel single family is going to be? If you think single family is going to be strong, Builder's looking nice. If you think single family is going to be weak, I don't know, Chief. I don't know. And it's new homes, not existing. Yeah, don't play around with it if you think existing home sales are going to do good. But if you think single family is fine, Builder's right there. It's pretty cheap now. And if you're into chart magic, it's hitting some support levels. If it breaks this level, watch out below. But and that's basically why I don't ignore chart magic entirely, but that's there's a rhyme to a reason to the madness behind the 110 strike. So if you sell a put, do you need enough cash on the sidelines to buy 100 shares? Yeah, well, there's context. So keep in mind, I do carry, it's sitting at roughly 16% cash, the portfolio. So I have cash. And then I'm also considering contributions. So I'm not going to discuss dollar figures. Maybe at one point I will, because I think enough people are members. They might, tell other people in other communities about the dollar figures or whatever. So it's not going to be like a secret for any. I've already effectively made it public. But the point that I'm getting at is there's a lot of considerations. You can make the argument that for some portfolios it makes sense, for some portfolios it doesn't make sense. Absolutely. So Sam Veers, well, yeah, you're called the keeper of secrets, but you don't keep secrets. You keep them to weaponize them. Big difference. People want their own backyard. So yeah, no. So that's why I'm pushing the topic onto you, because always I want to be careful. I don't want to tell you what to do. And I know that's not what you're asking of me. My audience, I love you guys. You guys are smart cookies. So it's really, I'm trying to guide you with it. And what are your thoughts on the particular KPIs? Do you think single family is going to be good? I think if that's the case, it looks cheap. No, maybe not. Multifamily is going to be weak, showing weakness, but I think Builders First is more a story about single family, new constructions. So I may, next time we talk, have a long position. I have no idea. I'm telling you that it is on my watch list. It's one of the enticing names. It is one of the things that I'm struggling with, not on a day, near daily basis, to be too many opportunities. It's one of them, but it hasn't kind of made it to the top of the list just yet. So not seeing much distress in current homeowners. I don't think you would find it in distress in current homeowners. It's about people in the renting class who are wanting to, and can purchase. And it's new home sales in particular. Yeah, because that's actually a different important input for other kinds of businesses. One of them that I love a lot. All right. Anyways, so that was not one. We also have Disney. How do you feel about Disney, Bacon?
It's there. It does its thing. Oh, it dropped below 100. That's funny.
Yep. How do you feel about that?
House of Mouse. It's funny just because when we've never gotten a clear picture on the line of succession for CEO, have we?
No.
Yeah,
not yet.
This entire time.
Yeah.
Yeah. I mean, setting social political views aside on content, House of Mouse is powerful. Those parks, even as bloated as they may or may not be, they just print money. And I imagine the cruise lines that they have are also doing the same. And if those are expanding, there's another possible growth avenue for them. But yeah, it's interesting. Did they though?
I don't know. I don't know.
Yeah, because the meme of the Disney adult, I haven't really like observed the phenomena, but apparently it is a phenomena that gets talked about. Which
I can attest to it that it is there.
okay, so the Disney adult real thing.
It is a real thing, and a certain other demographic that also has an incredible amount of disposable income. I'm not gonna. It's bad to. I don't even. There's a certain demographic that goes there a lot too, especially during this month. And they have a lot of money. They spend a lot of money. They have no kids.
I'm a little uncomfortable when it comes to what demographic you're talking about. But anyways,
no, Fuhat said. I just want to say.
Yeah. Okay. Well, yeah. Setting things aside. Yeah. This thing is a monster, but price can do whatever the hell it does. What are your thoughts when it comes to the streaming service? Like,
streaming's a tough business.
For sure.
I just okay. So someone said to me within the club that the password crackdown is going to present an interesting opportunity potentially. It did something good for for Netflix, which is one of my largest investments. Fun fact, it's actually if you guys were curious, within my within the holding co portfolio, it is not a very large investment. It's one of the smaller ones.
You just showed like weighted return.
Yes.
Okay.
Time weighted.
Okay.
No, I didn't show the portfolio.
Yeah.
No, I wouldn't do that.
Yeah.
Not here, no.
Okay.
But Netflix, holistically for my net worth, it's a larger portion of my overall net worth, and I don't view Disney as something that can surpass that, unless they got serious change at the top and culturally speaking. And great question. Disney has horrible margins because they're streaming right now. Their streaming is bad. It's just turning profitable. Last time I checked. The legacy business, great as terms of profitability, but not really a strong point for the business because that's going to be the declining business. Same with Warner Brothers. They're struggling through the same thing. The parks, the gem. That's the gem. That's making all the money. And fun fact, that used to not be the gem. Oh my gosh. By the way, if you go back in time to like 2019 and before, people were like the opposite. They're like, oh, the parks are fine. It's the media business. That's the gem. Wow. It's so funny to kind of watch people turn that around. It's really funny. After you've been investing for a long enough, I don't even think it takes enough time, that much time, believe it or not. It's like within 10 years, you'll notice like perspectives just like completely change. You're like, what? And then these newer investors come out and then they're like saying things that are, either reminiscent or the completely opposite of what it was like 5 years ago. And you're like, what the heck? But like, right now, for example, people who are just now starting investing, they think Walgreens is like this trash company. It very much could be, by the way. And I think it leans on that it is, or at least that it's challenged. But turn the clock back 5 years ago. You go on this platform and you look up dividend stocks, you will find people saying, look at this safe dividend aristocrat, Walgreens. 3M, same thing. You ask a newer investor today, hey, what do you think about 3M? Oh, 3M. Oh, that's disgusting. Turn the clock back 5-6 years ago, 2017 era. Oh my gosh. You ask someone, quick, 5 stocks to buy. And that buy and hold forever. Likely chance 3M is mentioned. Very likely chance. Today, not one person will say that. Okay? Not one person will say that. Maybe this is happening somewhat to Johnson & Johnson now, because I recall, again, 5 years ago, Johnson & Johnson's like, yeah, that's the buy and hold forever, blah, blah, blah. Now it's talc powder. And it's like, oh, I don't know about that. I don't know about that. And then, PayPal. But I've been consistent on PayPal. So for sure. But PayPal, It's the next Visa. It's the next MasterCard, Visa, whatever. It's the new age fintech. Now, I think deservedly so, some people will say it's grandpa's fintech, etc. But I'm saying like the popular statement back in those days. And I'm not saying, by the way, that's coined by Dan, as far as saying the grandpa's fintech, which I think is a great way of putting it. But he's been consistent. He's one of those that's been consistent. But I'm saying there's a lot of people today that were probably bullish PayPal at 300 and now like, PayPal, disgusting. So
funny how forever a lot can change within 5 years.
I don't have a hat on, but as I said earlier, this is not a law of investing. But if you share a position with Paul, be scared.
As a former everything money guy myself, I wholeheartedly endorse that statement.
Oh my gosh, you do get some love. I commend you.
Oh, that is power right there.
Yeah, I commend you. You have patience. Yes. I remember what it was like 6 years ago. Wow, you held it through that. Oh my gosh. And then you held it through the fraud allegations. Oh my gosh. Wow. No, that's commendable. That's commendable because hindsight, that was BS. And Rockstar CEO comes in, really changes it for the better. So Josh Brown is bullish 3M. I mean, no, 3M could be fine. No, it's definitely not. It's definitely not.
Maybe 3M, at least it had a blip for a little while there from a value investor perspective, but
yes, for sure.
Yeah.
But yeah, I'm so sorry that this happened to you. Yes, what do you think about Dividend Kings? I think the Dividend Kings is a cool little trophy, but nothing more. I don't think any business should be valued more just because it's the Dividend King. It should be valued based off of the quality of its ability to sustain those cash flows. I'll give you an example. I think Procter & Gamble might deserve a status as Dividend King. Not might deserve a status. It definitely deserves because it passed the threshold of being a Dividend King, but it deserves the recognition of a great business because look at the moats that they have. Look at the brands that they control. But let me give you another one that I think is even more powerful in that even though they're both Dividend Kings, I will acknowledge one is better than the other. But not that one I would buy. I want to be very careful. But if I own the whole business, I think I would have, insane confidence that my cash flows that my business produces will be there in like 20 to 30 to 40 years. This is what I'm defining, by the way, or how I'm defining this exercise. Coca-Cola. If I owned 100% of Coca-Cola, I may not, make as much money as owning all of Google or all of whatever. But I can say with a high degree of confidence that my business's cash flows will be very positive for many years to come. And if I want to go sell it, that the market, that willing buyers will pay me quite a hefty premium, even though it may not be growing that much because of the security of those cash flows. So as an example, but Dividend Kings like Leggett & Platt, industrial, cyclical, no. 3M, no. And I'm not saying this to be hindsight 2020. Look at the businesses and what they are. Johnson, I'll dare I say it, Johnson & Johnson, I would not view that in the same quality as the likes of Coca-Cola. Why? Johnson & Johnson has a greater capacity to make more money, absolutely, and to be a better investment, absolutely. But the security of those cash flows are going to be more under question. Why? It's a pharma company. Right. You see, I didn't want to only give you companies of the past because that's too much. Hindsight is 2020. I wanted to give you one from the current and say, okay, Johnson & Johnson still hasn't yet fallen from grace too much. But I would say Johnson & Johnson and Coca-Cola, I would sleep better at night owning the entirety of Coca-Cola than I would owning the entirety of Johnson & Johnson. But they're both great companies. I don't want you to confuse what I'm saying. So yes, it depends on the mode, depends on a lot of things. How about Coke versus McDonald's? Ooh, Bacon. We talked about this yesterday, but so I'll let Bacon say it first.
Too long didn't read on yesterday. McDonald's. If the statement is true as an anecdotal reference, when it comes to like a McDonald's meal, it's been said that Coca-Cola kind of like helps offset the cost for that discounted meal that McDonald's offers. And assuming that is the case, that is, you're saying you as McDonald's are one company effectively throwing your weight around against another heavy hitting big company. So in that regard, maybe McDonald's, but that being said, though, they're both really powerful companies, and where they go from here, I think McDonald's has more levers to pull. But then again, Coke is such a distribution monster that I wouldn't be surprised if they got something else in them.
No. This is what I was worried about. To clarify, no, compared to Coca-Cola.
Yeah,
I said that Johnson Johnson and Coca-Cola are both amazing companies. If I own the entirety of J&J, I promise you, I can sleep at night. But sitting next to Coca-Cola, I would feel more comfortable owning Coca-Cola. And it's a tough thing to say because they're both amazing.
Yeah, product pipeline sure does matter.
Yeah. Yes. Yeah. Fabio never sleeps. This is also another statement that's true. So, yes, you already mentioned about the McDonald's pushing its weight around, which is really cool to see. For full disclosure, I have a boomer investment in McDonald's. Fight me. So yeah, McDonald's, Coca-Cola. Did you say which one you'd own 100% of?
Oh boy, 100% of. I lean towards McDonald's over Coca-Cola. Are we talking Johnson & Johnson v Coca-Cola?
No. We're talking McDonald's versus Coca-Cola.
Yeah, then yeah, I lean towards McDonald's.
Me too.
Yeah.
Me too. Yeah. And just to be clear, for McDonald's, I only own it recently. It's basically at my cost base. So if you're trying to get the same basis as me, or you want a better basis, wait a little bit. Probably would come down a little bit more. In which case, I'll be nibbling more. But it's not really. What about Ozempic hurting MCD? No. They'll be fine. They'll be fine. Trust me. Oh, good question about Ulta Beauty coming in. Wait, Fabio, you can sleep so well taking sleeping pills from Oh, that's a good idea. That's a good idea. Oh, Netflix. Well, I'm happy Netflix is at an all-time high. My portfolio loves it. I wouldn't be buying more, but that's me. But they've executed on all fronts. They look really cheap on my cost basis based off of relative earnings or current earnings. So there's no reason to sell a wonderful company. It was a 2022, man. Oh my gosh. And 2020, 2022, those were the years. And okay, so I was going to do like a more broad review on kind of a reflection on the portfolio. So the point of investing, right? It's also security selection and portfolio management. Those are equally as important. And what I mean is it's finding ideas. And then when you find ideas, about managing the position, meaning how heavy do you go? What's your allocation to that position? What role do your other positions play within your portfolio? So reflecting on all the years, at least on YouTube and documenting and talking about investing, there's been several crucial periods, and it hasn't been like massive home run ideas every month, but it's been selectively finding different ideas and then knowing, okay, this is a wonderful opportunity. Let's go into it. 2020 presented many, 2022 presented many, and I got to be honest, 2021 was horrible. That one was a hard year. People say 2024 is a hard year. No, 2024 is not a hard year.
What?
2021 is a hard year. That was a hard year. That was a pretty hard year. So 2022, easy year, very easy year. But yeah, 2021 was tough. In fact, 2021 helped me a lot, actually set up for 2022. And that's why I had a very positive year in 2022. But in 2021, one of the best ideas that I found, and we're talking strictly long equities, and I'm not including the investments from 2020, but just the ones from 2021. All of the ones that I found good, I found at the tail end of 2021. I didn't find any at the beginning of 2021. So the ones that come to mind: Cardinal Health, the Aerojet Rocketdyne. Shout out to those of you who remember those investments. There was Activision Blizzard.
Oh, that was a beautiful one.
But all of them were at the tail end of 2021. So all the 2021 performance literally only came from investments made during 2020, during March and throughout 2020. And then Unum Group, which Unum's done really well. Even well, I don't think it's done that well after I sold, but I think it went above 50, but I think it's actually sold up. UNM. I can't UNM. Can't spell it. Okay, so actually it's right above 50 again. But no, yeah, this was crazy. Yeah, it literally was selling for a ridiculous discount to book. But anyways, what's the highest percent? Oh, easy, I can answer that because people ask me that all the time. 30% is like probably the highest I've ever been. 30%, give or take, not exact. I think at I didn't yeah, no, this year I've not really been that high. Well, if you're not counting, the thing, but if you're counting like real cash bonds, yeah, it's like 15%.
Yeah. I think I know a couple things.
Yeah.
So,
but yeah, that's a good question. But anyways, so coming back to this, like a lot of the returns have come from, select investments. And then when you identify them, you go hard. There's one that I cannot talk about that we will talk about. And Andrew wants to talk about it, but we're waiting because until we're not done, we're not going to do it. But that one was one as an example that all the club members can see. Yet again, another one where identify opportunity and you go large. So actually, there's several you could point out to right now. There's 3 off the top of my mind. Did your portfolio get crushed in the bear market of 2021? No, I just wasn't as positive. 2021 wasn't a bear market.
Wait, was it? No. Yeah, because when did the EV SPACs like blow up roughly?
I know that the SPAC trash blew up in like early 2020 or mid 2021, but I wasn't exposed to that.
Yeah, well, naturally,
yeah. So I didn't have a negative 2021. I don't think anyone had a negative 2021. Well, I think you had a negative 2020. You had hype and a lot of retail stuff. But I think he means 2022, but I'd like to clear. Oh, okay.
Yeah,
okay.
he did say
I meant
2020.
Oh, okay.
Yeah.
I was like 2021 because I'm trying to think what happened in 2020. No, 2022, I had a positive year. Yeah, I had a positive year. And in fact, so the holding co, the one that I showed the performance for, the one that I update quite regularly, there's the personal holdings, holding co, and Capital Mindset Holdings. The personal holdings was the one that was the most positive because I was doing all strategies, meaning I was doing common stock or straight equities and options. So that included hedges, et cetera. And so that did really well in 2022 strategy. And then the holding co at that time was long equity only. And so what I'll brag about is that despite the holding co actually doing a smaller performance at 9% return in 2022, and my personal holdings doing 20, I think it was like 26, 27% return in 2022. I'm actually thinking the 9% is more impressive because it was only long equity. And I was updating that to all the club members back then.
Yep.
So we were already doing updates.
Somewhere around there was also like pretty REIT heavy, wasn't it?
No.
Okay.
No, the holding co has never been.
Oh yeah. The
REITs
were
can never
before.
be. Yeah. Because the REITs, there was a video that you can watch on SRG and Heritage Growth Properties versus Realty Income. I talk about in that why I sold REITs. Liquidity crunch. You don't want to be in REITs. So if I believed that, I would have been insane to continue to hold REITs in a meaningful way. I think the only REITs I held and a meaningful capacity, well, a small allocation was realty income. But I had exited pretty much all my REITs in 2021. So, and then I began to enter, the famous KRC 2023. And yeah, the rest is history. So, but yeah, the going long only and not using any other was, I think, I'm more proud of that. But and then the performance in 2023 plus 2024, I mean, it's compounded quite nicely. And then we'll see what happens with the remainder of 2024. We'll do another end of the year update, because this is like the mid-year update. So we'll do end of the year update, and then we'll see what 2025 comes about. But I'm optimistic that I'm positioned for many different scenarios, and we'll see if we can navigate it. And then from here on, I mean, I don't know what the future brings. But okay, thoughts on NVIDIA becoming the largest company in the world for a short period? Jake.
Good old Jake.
So I'll ask you, Bacon, and then I'll answer. How do you feel about that?
Completely neutral. It's funny because like you're aware of the names, or you've been aware of the names that I've held from time to time. In the act report, I am shockingly light on tech. So yeah, is what it is.
Shout out to Bacon here. Actually, Andrew gave me his returns. I'll share those with the members.
Good old
I'll
Andrew.
share this not with the members, with everyone publicly. So Andrew's not here to describe or talk about his returns, but I won't really go into too much detail. I'll let him, if he wants to talk about it on a later live stream, but because this is also talking about performance updates, I'll also showcase it, and I'll mark it down for people. So we'll go through this super quick. Brief break to show analyst returns. Kind of impromptu. Oh, but I also want to say Bacon over here. What does he give me? Oh, yeah, he's giving me two separate groups. This is the year to date, 1 year. Okay, and we need to show this. Okay. So I have the 1 year, the year to date. We'll do 1 year first. So this is not my returns. This is now one of our analysts, Andrew. You've seen him on the live stream. We're seeing his return here. All dollar figures that are not shown, and you can see all accounts. The 1 year return 65.90. Like I said to you guys, Andrew's also done decently well for himself. His CAGR, I don't know if he's going to send me his CAGR, but his CAGR is also pretty good. He showed me his CAGR before. It calculates to like well over, I think it should be now over 20%, but I don't know if Fidelity does, because this is clearly, it looks like it's Fidelity. And then this is his year-to-date returns. So also pretty good. It is outperforming both the NASDAQ, the S&P. And fun fact, so I'll say this about Andrew. I'm not going to tell you what's in his portfolio. That's not my place. Mm-hmm. But in his portfolio, I can tell you he does not have NVIDIA. He is very underweight NVIDIA. And I guess I also have to, I'll show this as well, because he went ahead and shared this too. So this is the all return, 195.80%. And I believe this is since 2019. So you can already do the CAGR math. If you're, mathematically astute, you can do the CAGR, but it should come out to anywhere between 18 to 20 or 20+%. But yes, so he has not done this through investing in NVIDIA. Versus myself, he is severely underweight big tech. He likes other different opportunities. So I won't really get into what he owns. And I'll also shout out to Bacon here, who's not telling us his returns, but I'm going to tell him, you sit quiet there, Bacon. His returns have also been very good. And he is not long any of the stocks that are famous for doing really well this year. Bacon here is actually famously within the club very long one stock, Okay. So sorry. He actually already sent me the annualized rate of return is calculated per Fidelity. And again, you mathematically inclined people can calculate this yourself. Should come out to about 25% CAGR. So yeah, that's actually, I underestimated it. I was doing some mental math. 25% CAGR, which is actually really good.
Very.
Yeah, it's very good. But yes, bacon as well. And so it's everyone has different flavors.
Mm-hmm.
Okay.
Yeah, because I'm pretty confident Leo also has really good numbers as well. And he's pretty much like roughly the opposite of me. As far as like methodology or so on and so forth.
And then there's Leo, who's just like completely different from all of us.
Yeah. But he's also like really powerful.
He's killed it. He has had a really good winning streak with Nvidia. He was our Nvidia guy. He was our Nvidia guy. I had Uber too, but I didn't have Uber in the holding co, so I didn't get that performance in the holding co. But I got it in my personal holdings. Trying to think, but Axon, another one. He played Dell very well. He played the energy company. I'm saying these because they're not in his arsenal anymore. So any ticker I say is because he doesn't own it, except Nvidia. So you get that one, but that one, everyone knows Nvidia, so it's whatever. It's there's not a value add. But it's not my place to say his portfolio. So, but yeah, anyways, we'll get through some questions. So back to the questions. You guys said a few times in the past that cybersecurity is a really exciting field right now. You've been eyeing Fortinet or Palo Alto recently. Wow. Well, I mean, a few of us own Palo Alto. Some of us own CrowdStrike. None of us own Fortinet. I don't even think Jesse owns Fortinet. So at this time, he did an update on his portfolio recently. You can fact check me on that. But I gave that one to you. And we own it at lower prices. So I have an insignificant amount of CrowdStrike. It's really insignificant. I hate myself for it. But because Andrew's already talked about it publicly, he's publicly owner of CrowdStrike. That's been a contributor to his strong performance. And he's really bullish on the company still. His original cost base is ridiculous. And then Jesse is long Palo Alto, and he's not bearish CrowdStrike. I don't think he owns CrowdStrike, and I think he doesn't own Fortinet anymore. But he traded Fortinet pretty profitably. He understands the space a lot, so he has VKTX. Get out of here with VKTX.
Good times.
Leo will have better numbers than those since he. Yeah, that is true. He has one. But yeah, I think I have exposure. Oh, we already talked about Builder, by the way.
Yep.
Boba the dog, and we didn't dislike it at all.
Yep.
Oh, there he is. There's Andrew talking. So he's in the chat talking. Palo Alto, CrowdStrike, and then some people like Zscaler. I haven't even looked at Zscaler, but yeah, some people do like Zscaler. For me, is at 31 price of sales and CrowdStrike is crazy. That's something that Andrew has broken down on the evaluation side of things, but he's broken down why he thinks it's not that much of an issue. So, and it hasn't been an issue for long. Like how they can grow into that valuation is how he's broken it down. And he puts it at you're paying a premium price for a very premium company. And again, his original cost basis is ridiculous, below 100. So pin it now. Pin what now? Pin what? What do I pin? Just take a screenshot and post it in the server so you have it as like your trophy. Is it that Andrew said he bought VKTX? Well, you convinced Andrew to buy VKTX. Look, I'll do it one more time for you guys. Everyone, because the VKTX cult will have an uprising in the club, and there's only like 5 cult members. Maybe they're growing because that's what's happening. I think they're dragging people into their room and then just like converting them, and then slowly but surely I notice more people are becoming like a VKTX cultist. So we're gonna have to do like a holy war of some sorts.
No, please no, please.
Another holy war of memes.
No.
All right, but anyways, Here's Viking Therapeutics yet again, so the cult can be satisfied. I have to satisfy them because they're like terrorists. You know, there's like 5 of them in the chat right now. Look, Holy War 7, bro. Oh no. All right. You see, like, this is why we don't negotiate with terrorists. I'm told that I'm not supposed to be doing this because then, they just feel like they can get away with anything.
This is why we can't have nice things.
Yep. You see, look, they're just going off. People come in on their own. Yeah, through their own volition. Yes. You see, like, look, day trading mindset, Jacob. Now we have Andrew. Look, and 2 of them are mods. Like, they're infiltrated positions of authority. Like, it's over. The barbarians are at the gates. They've opened the gates for themselves. Oh no, not you too. It's spreading. What have I done? No. TTCFQ. This is better. This is better.
How many of the mods are actually like in that like stock or bullish that stock? Because for those that don't know, like, being a mod in Capital Mindset, like, holds 0 power, really.
Yes, it's a celebratory role, but you got to get to head mod or admin level, or head admin,
yeah. That's where you have some power.
Look, now you got Gil going in here. Gil's like, oh, now I'm in VKTX. Oh no, it's not. I'm not a terrorist. Oh no, he's a. Oh no, make me mad. Oh no, not you too. I didn't know there's so many. All right. Anyways.
No, Jake. Admin is different from mod from Discord perspective.
So, gambling on obvious. Biotech. I am not. I'm trying to appease the terrorists. Okay, and it's not working. They just want more. They're like, no. The whole stream has to be about VKTX.
It is not enough. You must dedicate it.
Let me regulate the memes and the gamers. And it's funny because I'm like, wait, why are you showing Khan's future here, Fabio? TTCFQ. Well, what are the other shitcos that we haven't talked about in a while? How's Fubo doing? That's another weird shitco.
Virgin Galactic also is another.
Virgin Galactic. There's one channel that Dan found. There's one dude that's like 100% Fubo. He's so funny.
Why?
I don't know. Some people just like to burn money. It's
I don't understand.
Some people would just really want moonshots. I really don't know. Other people just have a gambling addiction. They live in Vegas, so.
I guess so.
HNST. Oh,
yeah, good old Honest. Yeah,
Honest Company. Like, this is the one that he picked that was like, okay, this one maybe, but
even then,
yeah, because it's a CPG company. So in theory, a CPG company, if they build enough brand rep, and they didn't IPO via SPAC. So it's like I don't know if they raised capital with this IPO. I forget. It's been a while. But yeah, I mean, from the low, if you somehow timed it, you're up 163%. That was in October 2023. So wow, you suffered all of 2023 through opportunity loss. So from this point to then, or actually no, if we're being honest, get it honest. All of 2023, it's been dead money. So it's been dead money for 2 years. So yeah, and that's part of like the post that I was going to post tomorrow, talking about like the mistakes retail investors make and like dead money as being one of the mistakes. Fabio, Jeremy told me Voyager Digital was a good company. How are they now? I'm sure they are doing good with crypto mooning. Oh yeah, they're bankrupt.
Oops.
Oh, Jacob said High Tide. I'll be having a video on High Tide coming out where I interview someone that I interviewed first for the investing club, and then I'm going to make it public soon.
Yep.
So watch out for that video to come out if you guys are interested in High Tide.
I'm just glad Jeremy got to show up and see the recognition that he rightfully deserves. In this
what?
The recognition he rightfully deserves. In
this yeah, that's right.
Yeah, because he's here.
I mean, he can't really talk that much because like the entire loss in like one position like equates to the entire portfolio that he brags about. So
yeah, well, I mean, if Meet Kevin has an ETF, I'm sure he'll be a hedge fund manager any day now.
Yeah, that's true. Yeah. And then I think with the elf point that he brings up, there is something to be said that he didn't even understand the investment in elf really, because if he did, he wouldn't have sold any of it. But because I remember some members found like he did have more in the past and he kept selling it off and off and off, and so he's kept some of it. So there's something about throwing darts at the board and some of them sticking.
Yeah.
So
I mean, we've already been nice to Jeremy. Like he's not Paul Gabriel.
yeah, you're not Paul Gabriel, man. You're
Yeah,
not Paul Gabriel. You're way better than Paul Gabriel.
Yeah,
That
not a
guy.
very high bar, but
That guy is something. That guy is like, whew.
Yeah.
Paul Gabriel, for spending a moment on him. I mean, like that guy is like, I don't think it's possible for a human being, unless he's really just raking in daddy's money and then he's doing that. But I don't think it's going to be possible for him to make or generate the returns over his lifetime to surpass what he lost with NVIDIA. So like that's like something, because okay, we did this mental exercise, like who would you give your money to first, Jeremy or Paul? 100% Jeremy every time over Paul. Like Paul's really bad. Like Paul is a legitimate barometer of like, oh, he's investing in that. Oh, I should move away from that.
I got hit with the dirtiest question of all time.
What's
Who
your
would
question?
you park your money with, Paul Gabriel or Kemmer?
Oh, that's fucking hard.
That is foul. I know, right?
Oh man, that is hard.
Yeah. One for you, chat.
Kemmer or Paul Gabriel?
Could I do like some what rules? Yeah, we already know Kemmer has margined up his awful portfolio.
Yeah, I think that, man, it's possible that I'd have to go Paul, because I feel like Kemmer is just gonna blow it all up, and like Paul will blow me up, but if he has the same rules in place with his poppy, there'll be a stop at some point, and I'll have some of my money back, and maybe I can make an agreement with them that I can get access to like the real estate as part of my portfolio. So maybe I'll just like underperform, but I maybe won't like lose tons of money. Oh, keep in mind, so Paul also shorted Amazon.
Yep.
Pretty publicly. Back before YouTube, but pretty publicly. And one of the things that also irks me about Paul the most is he has the highest level of arrogance for someone who's underperforming terribly. And the other point is that he is probably the least of anyone in terms of transparency. You have no idea if he even buys any of the stocks he even claims, at what allocations. The only one that was definitely real was the NVIDIA one, because of how nervous he was.
Yeah.
And how he like looked like, oh no. Oh.
And he had the nerve to call his brother the emotional one.
Okay, so the issue of beater stocks is like there are it's really hard to get banned, but there's people that we've determined they're just not the right fit. They're just not the right fit. We're not a completely open anyone and all, as in like you can be even a bad person and get it. No, you may not be the right fit, and if you're not the right fit, you're not welcome within the club. Yeah. It's very difficult to get banned. You do have to do heinous things to get banned. You have to be how do I say? I'll just say it's hard to get banned. It's hard to get banned. You have to not be nice. You have to very much not be nice. So if Kemmer, the issue with that individual is, it's not my place to say. Maybe Bacon should say it. I feel weird saying it, but I'll just say it this way. I've heard from people who have served that his stories may be a form of stolen valor. And the way he portrays it is in a way that is very manipulative, to where he is doing this thing for internet clout that is leading to harm a lot of people in their retirement. So under that consideration, I think myself, the moderators, I think a lot of the members would all reasonably determine that he is not the right personal fit. He doesn't match with the culture in terms of morality. We are open to like any kind of mindset. We can even, I will accept a yield maxer. Actually, we adopted yield maxers during the time when I tried to convert and save some of the yield maxers. We've adopted some yield maxers within the club, and then they were about to be full-time yield maxers, but they're no longer, and they're actually practicing sensible investing strategies through low-cost index funds. And then they've decided, you know, kind of, oh, if I want to give this a try, we'll do a little bit in some individual stocks, and then let's see if I can outperform. And then that's the strategy you're going for. But yeah, with Kemmer in particular as a person, he would not be a good fit. He's also very manipulative in the sense like he tries to control the narrative because he doesn't want criticism. He's just like a megalomaniac from these autocratic regimes. So very Cambodian of him, you know.
He is very much one of those people who's like, yeah, I want people to criticize me or like offer differing opinions, and you know he's like itching with the ban button.
Yeah.
Poor Jake. Jake got banned from Kemmers. So did I, but
so let's see. Is Jeppy yield max? No, it's not.
No, different.
It's not the exact same thing as yield max. I think Jeppy actually owns the underlying.
No,
it's not a synthetic. So, yes, the irony of it all. Correct. And that's because people ask for it. But I tell everyone, you know, on the other side of things, I don't like PayPal. In fact, PayPal's caused problems for grandfathering in. So,
ironic.
Yeah, ironic. So that's the context. I was for foreign payers. Some of them prefer PayPal, but for most of the American ones, I don't think they really care. Most people have not really cared. It's like a few people who've requested it. And then they found that it ended up having more problems with the membership when, you know, if there's a price increase, grandfathering is a mess. It's annoying. It's a little bit more extra steps. So I try to do it so where like the customer or the member doesn't have to worry about it, but like I have to worry about it. So I hate it. So I'm like, fuck PayPal. But they could improve it. It's just like, I don't know why they don't choose to improve it. They improved it, they'd have a better product, but Stripe is better. So, because it's credit card / Stripe or, you know, PayPal, and Stripe's better, hands down. Oh, I don't know that context, the yes man.
Yep, I know it too. Good old
That's really funny. Paul quotes super investors, play game, watch video, name that quote.
Bonus points when he messes it up.
I guess someone send a video. Someone send a video for us to watch.
Oh,
and we'll guess the quote.
Please no. The brain damage.
Yeah. Yeah, you see, Andrew's got great performance. He's got great performance. And again, it's like seeing that, you know, all the different styles of investing, very good styles. So, and then you're being humble with that, Andrew. Like, we'll see what happens next year. I'm being more boomerish now. So, Cabo Mindset, can we get a camera portfolio update? Oh yeah, sure. We can bring this guy up. This guy's insane. I always like watching his portfolio updates.
So we're at the degenerate part of the live stream now.
Yes, I think unless people ask questions. People ask questions, we'll cover it, but
yeah.
Okay, so the cringiest portfolio on YouTube, a guy who literally doesn't know what he's doing whatsoever. So total gains and losses. Recall that this guy during a bull market lost like $10,000, and that was before. He's probably lost more. And then we've had another bull market this year. So the total gains and loss, negative 39,862.92. He's not showing the other page, so I don't know what the total gain or loss, including dividends, is going to be, but the other page would have shown it for Charles Schwab. This value is going up. and this value is also going up. So he's basically just increasing leverage. And I can guarantee you, based off of the figures, he's probably underperforming in terms of total percentages versus the overall market, which is more or less kind of in line with what I would expect for someone that is leveraged to the tits in toxic assets. He believes that it is free money. He's looking at the obviously like the income that he's gaining. You can see now he has no individual stocks. He used to have individual stocks. Now it's just strictly yield max trash garbage. And so even the fund manager at yield max himself will tell you in interviews, not even joking, that you should not make this a significant portion of your portfolio. You should keep it at a small portion of your portfolio and as a speculation at best. So when you're looking at Kemmer here with this entire portfolio made out of yield max, and he thinks he's making what is it, like $8,000 a month? No, he's not. And he's paying a lot of tax on it. Thank you for mentioning that, Dom Stocks. He's paying a lot of tax. So his real rate of return is significantly lower. And you know what? I feel bad for him because he's going to be broke. So I'm going to give him a like. All right, there you go. He gets one like from Capital Mindset. Okay, so I just joined. Perfect time. Citizen of the Year. Yes, you did. And Citizen, you get into that fight with those other guys, and those other guys are equally as cringe. I mean, that one guy who's like, if you talk over his head where he can't understand, he just says like, hey, I'm salting the slugs. It's bro, you're so cringe. He's the one who said, funnily enough, that is like, nav erosion. What nav erosion? Someone sent that video to me. I was like, this guy doesn't, and no, and it's the arrogance too. That's the part. It's the arrogance. And fortunately for him, he's like, there was another video someone sent me a while ago about him talking about, his investing and all that and what he wants, what his goals are. I have no idea how an older person doesn't also see the irrationality of desiring to be rich tomorrow. I expect that from an 18-year-old. I don't expect that from a 60-year-old. I expect a 6-year-old to have common sense about this. So
nope.
Yeah. No, right? Like,
no, just no.
You expect the 18-year-old to go to the 60-year-old and be like, I want to be rich tomorrow. I'm going to buy this stock and I'm going to, do this. And the 6-year-old to be like, that's not how it works. You silly moron. You young buffoon. You're going to learn. And then, you kind of see. But no, it's the freaking 60-year-olds and 70-year-olds who are doing this. And it's like, are you mentally disabled? Anyways, I say that because literally some of them are, very sadly, and this person's manipulating them. So 6-year-olds are not dumb. No, they're not dumb.
All of them. No, some of them we found.
Some of them definitely are. We found that some of them definitely are, but like unknown if it's like they're dumb in the sense of lack of experience or dumb in like they're IQ challenged. I don't really know the answer to that, but oh well, F the boomers. Sure, I guess you could take that approach, but then you're gonna have to pay their welfare. See, that's a selfish reason to help them. If you want a selfish reason to help them, if you don't help them, then you'll be paying their welfare because that's our system. So we're gonna pay their welfare, and then they get mad when you say that because I said that to some of them, and they're like, harumph, I say, how dare you say this? And it's like, yeah, it's like the truth. What do you think is already happening? You're in a tough spot. You're putting yourself in a worse spot, and I'm gonna have to pay for that. All of you are gonna have to pay for that. So day trading mindset has a vendetta. What's he doing?
Good old Al Koj.
Oh, Koj. All right. Yeah. So Capital. They also say the stock price means how much cheaper or expensive. Oh yes, I've heard that before.
Same.
Oh my God, that is. Tell me you know nothing. Not even like the basics. That is like lower in understanding of investing than all of the typical finance YouTubers that we cringe at. That's lower than them. That's who has that like Kelly OG level understanding where she goes like,
there's a name.
Yeah, there's a name. Jeez, that's cringe. That's cringe if you fall for that too. By the way, if you fall for that, that's pretty cringe. Stock is at a 52-week low. Must be getting a deal. Yeah. What stock are you talking about? Oh, JP's in the house.
Hey, good old JP.
Yeah, JP's been a busy guy.
Oh yeah.
Frat on top. Oh no, the cult is taking over.
Fabio,
So, yeah,
the greatest financial YouTuber, has uploaded 3 days ago, and I didn't realize it. Bird Lady Roller Pigeons. Let's go.
send it.
Matt, if you know, you know. No, I'm not doing that.
Bird Lady Roller Pigeons. Bird
Yeah, you
Lady
don't remember
Roller
her?
Pigeons. Bird Lady.
Yeah,
What's she talking about?
all right, fine. I'll share the channel. It's so cringe and goofy, but I'll share it in the stream.
SEC files complaint.
Oh, you found it. Yep, the greatest financial content. Behold.
We live in a world where this person and Meet Kevin exist. Oh, you know what? Let's clown on Meet Kevin for a moment, just a tad moment.
All right.
So I'll talk about a pitch I gave. Let me go to the private videos. Beta.
Yeah, apparently she has her own farm, so good on her.
Yeah, good on her. Okay. Let me try to find the exact time when I'm talking about his tweet. Hold on, give me a second. Okay, so here we go. So this is one of the private live streams that I discuss. And wait, what's this private chat? Oh, you sent me this.
Yep.
Okay, so here you can see the date, etc. Blah blah blah. But the point is, look at what we're talking about here. So in this part of the video, I'm not going to play it, but and you can see it's a 2-hour stream. But part of it, it's a call to action, right, for the club members. And at this point, there's a bit of a sell-off in the market. If you guys recall, you can check the date, map it to the market, and see where we were at. So actually, we'll just do that. So I'll do that for you guys too. So 4/3/2023, we'll do VU. And we'll do year to date. And then here. So this period here, we had a little blip of a sell-off. And the point was what we were discussing. This guy who is pretty good reverse or a not someone you want to take seriously, Meet Kevin. So Meet Kevin has done a lot of things wrong. And in fact, I'll say this about him too. The other YouTubers that we've discussed, also, I struggled to find many that have lost as much money as him. So he lost roughly, maybe out of the 40 million, he lost about 30 through a series of unfortunate events and investing in shitcos and potentially companies that maybe or may not have, paid him to do so. So when we get to this point where he's tweeting this, it's kind of like, okay, you're clearly a sensationalist and a gambler, and he does all these things with options, right? So my only response, which is, I think as best as I could, was laugh. Of course, for the context of the call, I'm talking about the discussion, the call to action, go long beta, which is a fancier way of saying on this dip, you go long the market on this dip. So again, 4/23/2024, which is right here, as I was showing you earlier. So you have Meet Kevin, clown, saying the sell-off begins. Oh yeah, buddy? Right? And it's not even that big of a dip. Look.
No.
Oh yeah? No. Go long beta. That was a great call. And so the portfolio performance is because I eat my own cooking and I went long beta. Now, how I did that is a different story, but you go long beta. So that was one of the calls to action. And I wanted to clown on Meet Kevin for a second because he's also an indicator you might take as maybe a contraindicator. So there's many contraindicators out there. You just need to figure out. You can think really hard on which ones they are, and it's okay if they find out they're contraindicators. They can't be otherwise. It doesn't matter. It's their thought process, and it's not something that can be changed.
Yeah, some of them refuse to improve.
It's not even. Yeah, it's good luck improving.
Yeah,
good luck improving. But yeah, that's one other thing I wanted to shout out. But yeah, that's one of the private live streams that was interesting and aged pretty well, but if you don't mind me saying. So the Holy Trinity indicator. JC Joseph has his things, but there are JC is Joseph Carlson. Joseph has a tendency to be very fickle. That's true. That is true. I remember he was buying Tesla literally at the peak. Yes. Yes. Let's see. All right. So if there are any questions, go ahead and ask them. Short Tesla? No, thank you. There's way better short opportunities.
Which may or may not get their own future victory lap content.
Yes. Yes. So an example of a short we did earlier this year. I can talk about it because it's over.
One. Yeah, it already happened.
We shorted Peloton.
Not Peloton, Perry.
Oh, sorry. Someone said Peloton in the chat, so my brain said Peloton. Perry on Networks.
Mm-hmm.
So this one was a great short. Let me zoom out the chart. We literally shorted and pitched it here to the club. I didn't participate in this last leg drop.
Neither did I. But yeah, those that did. Yeah, Jesse made out like a bandit.
I think like 1,000% return, something like that.
Yeah.
Yeah. But yeah, I remember when I first told you guys like what strike I was doing, you guys were like, whoa. I was the aggressive.
I want to say I was the one that was like somewhat closest to you, and like you kept hassling me for the longest while, saying I was bullish.
Yeah, because I said jokingly to the other guys, I was like, you guys are bullish compared to me.
Yeah.
For context, so the price was like $22, right? And so this is a pretty novel idea at the time. We're going to short Perry. So I bought the $12.50 strike. And at the time, that was thought of as like, whoa, that's
a lot.
That's pretty aggressive, especially because it had to get there by next January. So January 2025. And I was on vacation in Aruba and woke up one day and this happened. So like within a day, they basically were up like 700%. And yeah, I think if I had held them, they'd be up even more. So, but yeah, the original reason we didn't know if it was priced in or not. And frankly, it could be that this company could be a zero, but I don't know if there's fraud.
Yeah, for right now they have that cash pile, but they're burn
which is
rate.
A concern.
Yeah,
which makes it a difficult short right now.
Yeah, right now, yeah, for sure.
Ooh, this is a cool question.
Ooh,
worst investment mistakes, newbie or experience? I will let you go first, and I'll.
Oh dear God! Well, let me say for the record, I've just made just about all of them, except for FOMO. I want to say.
Yeah, you don't FOMO. I try to make you FOMO, but you never FOMO.
Yeah. Like I mean, like when it comes to peer pressure from someone I'll respect, I'll like begrudgingly have like a single meme share, but it's as far as I'll go. And you really got to hassle me. But yeah, worst mistakes for sure. Under allocating when I have high conviction. Pulling the plug too soon. I did that with Meta. Like I had nice returns, but undercut them in hindsight for sure. Allocated in hindsight or in the past, I would allocate too much to specs. Speculative positions. Now I have a proper framework being no more than 2% as far as initial size goes, like at most. Probably playing with the soap a little too much also, as far as like any sort of portfolio rebalance. And that I want to say is about it for now. Like I've had like different fits when it comes to due diligence, but thankfully with the club, like that. Honestly, that's my biggest value add from the club is like collaborative efforts on due diligence. Like I'll miss things, and it gets caught before I initiate a buy order.
That's at the end of the day, that's the goal. It happens to me too. Like I said, I'm just the figurehead at this point. There's a lot of people who are all the value in and of themselves. So I'd say for myself, I mean, I was kind of blessed that in the early years, I had basically the gift of having someone who is way more experienced than myself sort of guide me through a lot of the beginner mistakes. And that included, I had desires to try certain strategies, and then it was explained to me why those strategies. So maybe if I didn't have that, like for example, if you have a community of more experienced investors, that can help avoid, because you can be told, hey, there's a reason why this is not, because we've tried it. We were there. It's fairly normal, for example, for a youngling to want to try out income for a little bit. And I didn't actually get to put it into practice because I learned that it's not the optimal way to grow your capital, and income is a consequence of growth. And I see that very much today more than ever, that as you grow your portfolio, then the ability for you to generate income, it's the opposite problem. You start to become like, okay, how do I minimize the tax liability because it may be spitting out, bit too much income. Dividends start to become not something you crave, but it's almost like something that you're like, maybe I only put the dividends in my retirement account. Maybe you know what I mean? You start to optimize in those ways. I can talk to you about public failures recently. So ones that were public, that were public facing. So Dollar General was a public failure. The REITs still haven't played out. So that's a failure for now, but I still believe in them. So we'll see. But yeah, Dollar General was a public failure. I got out. My average sell price was in the 130s. We calculated it the other day in the broker. We did the average. It was about 130 something. No, I don't count BFI Fuhad because it was a joke position. Come on, you know that.
Yeah. Bunger Fi.
Shockwave Medical. Wow, that's a name. So yeah, there's instances where I can point to. Thank you for bringing that one up. Where I played with a soap, maybe it sold too early, but that's a little different. We're trying to find failures of permanent capital loss.
Mine would be everything money days.
I'm trying to think of if there was this one was an almost big one. Baosun.
Oh, really?
I told you guys, yes.
Oh, yeah.
So like, I wasn't always this, I'm woke to the Chinese VIE trash. You don't own crap. No, there was a time in my life where I was also, this is like way back 2017. The China of this, the China of that. I had a lot of, and so it makes sense when you kind of consider the context. I had a lot of success with an investment that you may know, Shopify. And then I had a lot of investment with another one called Mercado Libre, which was like the Shopify of Latin America or the Amazon Latin America, however you might call it. And so, comes across another one. And thankfully, what got me out of it was something else, was part of their business structure that I didn't really contend with. And so it could have been a very big mistake. But the point is, I did buy a Chinese VIE. And at that time, I didn't understand the nuances of it. So I was ignorant to that. And that's a mistake that a lot of newer retail investors do. They genuinely do not, and they think they do, but they don't. But I bought, Baosun, what's the ticker? BZ. Let's find it. BZUN, I think. Yes, here it is. Look at the destruction here. So if this was a hold for a while, oof.
Ooh, buddy.
Yes.
Very nice. The blank of blank.
Yes.
Gotta love that.
The blank of blank. Oh no, it gets. I think let's go back to like 2017 so you can see.
Yeah.
By the way, so I felt that I was a dumbass for selling it for a little bit, and then I don't revenge invest. I tend to revenge invest, thankfully. But yeah, this is the period back here, back in these 30s days, and it was like volatile for a moment. Yeah, and I thought I was a dumbass from here, but look, I mean, even we take the lowest point, say I timed the bottom, you look like a genius. Long term, terrible. Would have been terrible. But anyways, so that was one. Humana Dex, actually, remember that one's the inside joke that I somehow had inside information on it.
Humana.
So no, that one I thankfully got out of. So
yeah.
Big mistake was not buying. No, I'm not going to count companies I didn't invest in, because then it's like I didn't invest in Nvidia. Biggest mistake.
Averaging up though is one of those things that like it took me a long while to get used to. I still struggle with it from time to time, but
no, I know you're joking, Dex. Don't worry.
Yeah.
I know you're joking.
Yeah.
But no, trying to explain to the audience member, because they don't see the context.
Hilarious thing though is like for me, way back when, like Intel was one where like either I got out sideways or didn't lose much, and it was great because it was the incentive for me to seek out a community like
Wait,
this.
I got to call out Fuhat.
Uh-oh.
What is wrong about this? What is super wrong about this?
Yeah. How you keep making money trading it, I don't know. But
no, but like, he's trying to say that's a loser. Fuhat. Yeah. Actually, because I love making bets with Fuhat.
Oh no.
We will do no, this is serious. Fuhat.
Darn it.
One Chipotle bowl, double steak value. Right now, we will provide, and we'll watch it live. We'll have witnesses in the club, and we'll see the buys and sells of Intel if you accept. I need food for not tomorrow, but Monday.
Please don't, Fuhat. I don't want to make another entry in the capital mindset lore.
Dude, I love milking him for food. I don't know why he takes like the dumbest bets too. Double steak in this economy. No, it's a joke too, but I started doing that because Fuhat sometimes, like, I don't know, he has like brain lapses. And so it's a way to encourage him not to have brain lapses. There was a question I saw somewhere. FRC, we had a small amount in FRC.
Yeah, that was an interesting time that I sat on the sidelines for.
But I did light money on fire. I didn't hold it to zero, but I effectively lit money on fire. At least if I set money on fire, it would have given me heat. That is very true. I always like to say that about other people.
Pablo Escobar.
Fabio milking the pores. He loves grifting. Yes, no, I will milk Fuhat for steak Chipotle bowls. I need him to accept the challenge, though. I know he won't, but no, for full context, it is also pretty famous within the community that Intel, we've been in and out of Intel accidentally on right times. The last time we exited Intel was because they were bragging about the results that hadn't manifested, and I would already doing reports and weekly calls talking about how Intel's rising off of like no news.
Yeah.
So there's there's nothing wrong with Humana. I had sold Humana because I needed capital for another investment, and the timing was like suspicious because it sold off like I think the next day. And so everyone made a joke about it that I had insider info. I didn't sell the full position. I sold most of it. I kept like $4,000, but I sold the lion's share of it. And so I missed out on all the. If you bought it recently, you're fine. You see, look, he doesn't want to take it.
Well, that's good. That means less work for me, because for whatever reason, whenever a bet gets made, I have to help like try and do that, like annotate that. I don't know why.
Why the more frequent use of options in the last while? No, so wait, I don't know if you're in the community, but I stated from the very beginning when I first started doing my portfolio updates on YouTube that the portfolio update for my personal holdings, I'm doing options, but I'm not talking about it. So I was always doing options. You just didn't know about it because I wouldn't talk about it. I would talk about my equity longs. Is this something you've always been doing? Oh, so you already, yeah. So yes, it's something I've always been doing. Is this because the nature of the current market gaining more confidence? No, in fact, the options, I would argue, is more of an expression on occasion. The way I'm doing it is more an expression of caution than anything else. I'm expressing long ideas without committing capital to them. So less downside if I'm wrong, more upside if I'm right. This is the Q&A part of the live stream, Lincoln.
Yeah.
I agree with you on this. Cal Mindset has MCD has moved $4 since we started. Well, don't worry. You have a whole year, buddy. That was a bad bet.
Oh no.
That was a bad bet. But for context, like I said with Fuhad about, we've already made like 2 bets.
Yeah.
And it's I need to consider saying it this way. Is there a phrase for when the bet has like 2 legs, and then if one of the bets is fulfilled, the winner gets like a double up? Is there a phrase for that? I'm not a gambler, so
I don't know either. I just know that I like put it in the friggin' lore section of all places.
Yeah.
And you guys agreed to it as far as how it was written. So this is my life. Help me, chat.
So does this sound sus? Less downside if you're wrong, more upside if you're right?
It depends on your capital allocation. Because like from a capital intensive perspective, maybe it's a little bit more capital efficient with the trade-off of more of volatility. You really caring about volatility, especially in the short run, maybe. But I don't know. Like to be fair and to be clear, like yes, I also have and am currently doing some options plays, but I've drifted far away from that as time has gone by. More of a simple common equity guy.
Because I'll express it in this way, if you can understand. So something Jesse and I both did with one stock. I won't say the ticker, but there's a stock we both had commons in. We both think it's very cheap. We think that there's a defined catalyst at a specified period of time this year, and so we decided, well, we think we're very confident in this being correct, but I think we could use this capital, this sum of money, into other investment ideas. So we both came to that conclusion. We're like, okay, we could probably sell the commons, and we sold them for a small, tiny profit because they hadn't moved much by that point, which is good because then we looked at the premiums and we didn't have to pay that much. And then so we sold all the commons. We freed up all that capital, and we can invest in our other ideas. But we were fairly confident over that defined period of time, over that catalyst for that company, what was going to happen. So we could express the exact same trade with relatively the same or more upside with far less capital because you're paying the premium. So you're paying the premium to control that quantity of capital. The math, that's how the math works out. So I don't have to put as much capital into the investment idea to get the same nominal dollar upside. The percentage upside is going to be way more. Of course, you're wrong, you lose it all. But if you're wrong directionally and on the timing, then yes, the loss potential is all of what you put in. But versus the allocation that the position previously had in the form of commons, it is going to be far less. But it's going to make the same dollar figure, roughly speaking, give or take.
So yeah, Dom's is saying asymmetric bets, but with an element of capital efficiency depending on the play or how it's executed.
Yeah, that's portfolio management. It's a secondary skill that's just as important as picking an individual company.
Mm-hmm.
So portfolio management, how are you exposing yourself to it, etc.
Yeah. Underappreciated topic though.
Yes, very underappreciated. It was definitely Starbucks stock they are talking about. What?
He's saying that you and Jesse did options on Starbucks.
Starbucks. No, it's definitely not Starbucks. But let's talk about Starbucks. We can talk
Yeah,
about
why not?
Starbucks.
Why
That
not?
one we can talk about publicly. What do you think about Starbucks? Be honest.
In the past, I used to be very bearish or concerned about Starbucks because of the China exposure. But it turns out that that is pretty overblown on my end. So, my bad, everyone. I did not help the topic at hand. But probably an alright opportunity, just not for me because I already have a lot of companies that are kind of like this play.
Right?
So,
You're having the problem.
yeah.
You're like, all these opportunities, which ones
Mhm.
do I go for?
Yeah.
Um, day trading mindset. He now
Oh,
has
he uploaded the picture to the naked guy or the near naked guy.
the Viking.
Yeah, yeah. Good on you. Good on you.
Oh my
I'm
god.
glad you like nearly naked men. Oh, Koj. It's good. You embrace it.
So, oh wait, I got to answer this
Ooh.
first, but we will do this.
Yeah.
So, yeah, Starbucks, I like it. It's
Yeah.
formed the triple cross indicator, which will remain a mystery what that is because it's more of a joke, but I also don't want to lose the
Yep.
edge that I have. But yeah, no, Starbucks, I
Should work.
bought some shares. It's very small. I joke with Ryan Dengler all the time, just try to get him to buy more, but it's not big at all.
Yeah.
So, all right.
Rank to 3. That's tough. I'll defer to you. You go first.
Amazon, Meta, Google.
Okay, cool.
I can explain why, but
fire away.
it is tough to do, but the Amazon has currently the best cloud
Mhm.
and the greatest undefeatable funnel for ad tech. Meta has shown and to be the highest potential to discovering the best and most affordable way to get compute via their own silicon. And then Google is only last because the management sucks. They have wonderful assets. Look where we are. We're on YouTube.
Yeah.
Wonderful. I have YouTube Premium, YouTube Music there, Google One. What can I say? It's pretty good, but it's like a solid, yeah, like FinTech Boy said, it's a solid third. It is a solid third, you know. So you're talking 3 behemoths, and you got a solid third there at the end. Not a bad company. Not a bad company. But Amazon, I like more than Meta, than Google. And funny enough, well, Meta got to a point where it's going to be very difficult for me to make it Amazon larger. I'm trying in the holding co. I kept putting more money into Amazon, but like Meta kept going up, and so it's like it was tough to get Amazon over Meta. But they're roughly like the same size. I have them at equal weight. The one of these 3 that I don't have in the holding co, but I have in my personal holdings is Google. So I missed out on that performance actually, but I have enough Google. It's fine. They all pay dividends now except for Amazon. So FinTech Boy, you can argue that Google's cloud is better than AWS from a tech perspective. I haven't heard any engineer I know say that they prefer AWS or Azure over them. It depends on what you're using it for, but I've also heard the same thing, that Google Cloud is better for certain kinds of businesses. But I've heard that Azure is like the worst one, but not that much worse, but it's like very convenient for plugging and playing with other tools. So it's still viable.
To entertain Boba the dog's question, if price were relevant, do you think the rankings change at all?
Ooh, very good question. It's still the same though.
Okay, all right, fair enough.
But,
if it's still the same, then it is what it is.
yeah, because Meta and Google on a forward basis trade roughly the same. Meta still has better management. Google has worse management. Google has really good assets. Meta has amazing assets too. Again, Meta, the same things are true about the silicon, and Amazon is completely misunderstood how the valuation is. So it looks cheaper than what it really is, and people are realizing that. This recent breakout, I think people are starting to realize the the power of Amazon. Well, this whole year it was like people realized, well, last year too, people were realizing how much money Amazon can make when it wants to. So in the way that people can perceive it, because if you know accounting, you can shift through it and kind of understand the business and see how it. Same thing with Netflix. That was another thing about Netflix. No one understood Netflix, or no one could understand Netflix. It was hard. You go on YouTube, and I got so much hate for buying Netflix. It was not even funny.
No.
Oh my gosh, because the narratives where it can't produce cash. I was like, no, not true. They even have a presentation for everyone who's accounting inclined to go through, and you can learn how to read the financial statements of a streamer. So, anyways.
Interesting question. What are the most interesting sectors of the market in this moment? Thanks. I am going to butcher that name, so I'm not even going to try. I apologize.
I'm going to try Ovidio Frassier. I don't know.
I speak the third most Italian.
Italian. Anyways, so that's a great question. I think right now, if you're thinking about cheap, sector wise, so we're getting pretty broad. Tech is not overbought, actually, depending on what parts of it you look at. There was, for a brief moment in time, enterprise software. If you count that as a sector, it's not really a sector necessarily, but enterprise software. Someone said REITs. I was going to say REITs at first, but then I switched. I wanted to say enterprise software first, but REITs too. REITs are very cheap if you think rates are eventually going to come down. They're very, very cheap. In fact, certain inflow data is showing that a lot of large players are making bets on some REITs now via options. And it looks like it's pointing to a bet for lower rates because of the kinds of REITs they went after.
Wait.
So
options on REITs? What?
I know, it's weird, right? A lot of
weird.
it too. Yeah. Because I think REITs are a way to play rate decline. I think there's, for me, I'm not going to be that aggressive in chasing something I don't need as far as returns go. Especially, I have like these 3 options plays that right now are playing out. I'm going to let them play out some more. And for me, I think I'm going to be fine just buying the commons on a few REITs that I've identified that I really want exposure to, and they're my favorite by far. So, yeah, and they're cheap. Undoubtedly, they're cheap. I frankly think you throw a rock. By the way, there's a YouTuber who dedicates himself to REITs. I caution everyone who listens to him. You guys know who I'm talking about. If you know, you know. But he's bullish all the time on REITs. He is never not bullish REITs. I say this because way back when, I think it was 2019 or 2020, or was it 2021? It was already when rates were really low. I was talking with him. So that would be, 2021. Oh, no. Yeah, it was 2020 because that's when I sold REITs. So this YouTuber also writes on Seeking Alpha, and I commented on Seeking Alpha. We got into a discussion about rates and where they were at and how that might affect REITs. The individual, again, if you know who he is, you know who he is. The individual responded back to me saying that, rates don't really matter. REITs do good in both environments. And I was like, what? Respectfully, I disagree. And so that was me. And I discussed in the comment, okay, I'm selling my REITs. You believe what you want. I'm selling my REITs. And then go figure, conflict of interest here. He has a service that's not cheap, where he sells you a service where he does research for you for REITs, and that's his focus. And so, of course, every environment better be good for REITs because that's good for his business. Where I disagree. And so I want everyone, if you know who I'm talking about, just be cautious because he is a person who, I think, well, I've shown all the club members this because I made a point to highlight this. They can back me up if this is not true, but I showed the comments with that author who does YouTube videos. You know who I'm talking about, right? I don't want to say his name.
I'm drawing a blank on the name, but I remember though that this definitely has been covered.
Yeah. So I just don't want to say his name because I don't want to disparage him, because I think he does good content. I think he does good content. But he showed himself to be someone who's like, he's like, Peter Schiff. It's like crash this year, crash next year, crash. So he's going to do the same thing with REITs, but bullish. REITs are bullish this year. REITs are bullish next year. I look like that somewhat because I did the same thing in 2023. I say 2023 is the year of REITs. We're in 2024. I'm going to say it again. 2024 is still the year of REITs. However, me and him, we are not the same, because in 2021 and 2022, it was not the year for REITs. Okay. It was not the year for REITs. It was the year for REITs. It was the year for REITs in 2020, 2021, 2022, 2023, 2024. You get the picture? So yeah. Yes. You see, like, I feel like, oh, you know what? This is another thing. If going back to the question of like, oh, early mistakes, I listened to Peter Schiff too. He was a guilty pleasure. I think everyone goes through that phase. You listen to that crap, and then you're like, oh no. You have to be careful saying these things, but some people may engage in the collection of precious metals due to the early inspirations of gentlemen like Peter Schiff. And some individuals may have continued to collect precious metals because it became a hobby of sorts, collecting coins. It's fine. Perfectly normal. Brad Thomas. Oh, Brad Thomas. I know who that is. Yeah. Brad Thomas is another guy. Yeah. But he's the same thing. Always bullish REITs because he sells a service that's bullish REITs. So he has to always be bullish REITs. Peter Schiff, bullish gold, sells a service. He sells gold. I feel like Meta could, well, man, if that happens, then oh boy.
It's always fun to see how the big four, I'm throwing Apple in the mix for big four, shout out Jake, have always seemed to like try and undercut each other a little bit by little bit here and there. It is fun.
I tend to agree. Google, well, unless you count YouTube, but I don't count YouTube as the same form of content as Instagram. It's completely different taste and a completely different base. I'm sorry, Instagram is not being taken over by YouTube. It's not. Yeah. And vice versa. Instagram's not taking over YouTube.
No.
So, and Netflix is not. I don't agree with anyone who says YouTube competes against Netflix. That is not true. Not true.
I want to take a look when social media got mentioned, because for the longest time, it was either like the founder or like one of the execs of Snapchat said, "We're not a social media company. We're a camera company." Oh, they finally changed their home screen. Damn. Because
we're not a social media company. We're a camera company.
Yeah, I know, right? Why would you want to be valued as like a GoPro?
Oh, there's a name.
Yeah. Another name. Snap Inc. No, yeah, you hit Snap Inc. Oh, okay, it's a technology company. They changed it now. It only took them however long. All right, winner. Bullish Snapchat now.
Curious.
Probably horrible.
There was that whole hype cycle around their software that I thought was like interesting if they could execute, but looks like they didn't. All right. Yeah. I don't understand why you'd own any large cap stock. What advantage do you think you have? Do you really think you see something that hundreds of analysts don't? Just my opinion. Why did I go crazy ape into large cap when no one wanted it? What was the market not seeing there? I get the premise of the question though. Mm-hmm. And in the reality, it's what do you think the market is pricing in? Unknown. You have no idea. I have no idea. We can make guesses. I think that what large cap tech has shown in its outperformance is that people really misjudge the scalability. For example, market participants, when you're indexing, you're basically saying market participants will figure it out. And the market will figure it out over a period of time. But efficient market hypothesis is sometimes bastardized by the people who follow it, making it sound like at any given moment, at all times, even over the short term, that markets are efficient. This is not true. Even the proponents argued it's not true. Efficient hypothesis is not disproven because inefficiencies can be found in the short term, though. That's a defense I have for it. So to be clear, I am a believer in efficient market hypothesis, but with the added nuance that just because you find that there are inefficiencies that may come about for many reasons that it could be, but we're not going to get into that just now. That does not disprove the theory. It does not disprove the theory. The theory is completely fine. It does not need or necessitate no lack of inefficiencies to ever exist. And that's what people get wrong. So, and then let's go with the full question. What advantage do you think you have referring to me, or you're referring to like in general? Because
Generally,
I mean,
you is my guess.
if it's general, I mean, frankly, most of the time, most people don't. Most people buy the hottest stock. You have the shoe shiner mentality. Shoe shiner, I forget where the quote comes from. Let me get the actual quote. Joseph P. Kennedy, back in 1929. I always forget his name, so I want to give him the credit. Joseph P. Kennedy was famous for saying that when you're getting optimistic stock pitches from your shoe shiner, you should be very careful. So that's what we're mainly referring to. It's not to be derogatory towards certain people. It's just saying when normies in modern lingo, that's like saying when normies are telling you, oh, this is a hot stock, you should be a little bit like, oh. So, go around your workplace. How many people are talking about NVIDIA?
Yeah.
Maybe it's a sign. Not saying this is the top. It may not be the top. It's not enough information to go off of it's not actionable is what I'm trying to get at. It's not actionable in either direction. So there's a lot of fogginess. And then the next part of the question, really see that hundreds of analysts don't, just my opinion. So no, absolutely true. But that doesn't mean that there isn't moments in time where there isn't blips. And first of all, analysts oftentimes are not looking at further out as much as you might think. They're
fairness
just not.
Fairness to Baron Wuffet. I recognize that there's a character limitation in chat, so it happens. Random thing though, when it comes to efficient market hypothesis, it's interesting that I want to say Meb Faber actually hosted Kenneth French this year, talking about his views on efficient market hypothesis, because it was him and Eugene Pharma.
Yeah.
And they co-authored basically that entire paper. So I just love like sitting back and listening to people talk about their viewpoints, right or wrong, about that topic.
Well, what did they conclude? I'm out of curiosity.
Oh, Pharma, or rather French on Meb Faber. One of the things that he mentioned was like from a perspective of like outperforming the market. He brought up like what's his name? The early days of Jim Simmons, way back when. He's like, yeah, you can have outperformance, but do you have access to the person or the methodology? And he's like, I, as myself, like I never would be able to, can't. So like it was a different like perspective that he approached his own co-authored work. So that was like one of the things that stood out. It was an interesting video that I've forgotten large bits and pieces of.
Yeah.
But yeah, something for viewers to consider if they want to.
No, 100%.
Yeah.
What's the name of the interview so people can?
It's Meb Faber's. Hold on, I'll throw a link in the private chat, or rather in the thing, the StreamYard words.
And
there we go.
I'll kind of repeat the question back to you, Baron Wuffet. I finally got used to your name. So for example, and this is what I'm a bit of a guilty of, and thank goodness I got the performance I got without NVIDIA, but I'm on the record for our analyst Leo telling him roughly around $400 a share that I don't see the value. He saw the value. Why wasn't NVIDIA already fully priced? Why did it continue to do that? Why was he right? And he was right in his diagnosis of what was going to happen. And this was already after a big run up. And if you looked at what the popular opinion was, I shared the popular opinion. I was in league with the shoe shiner. You need to understand this. And I sit poor for it. But he is presumably also an analyst. But he actually is an analyst. But he's an analyst among many analysts. Why was he there and putting his own capital into that investment? Why did he get that return? Who knows? You know, is it luck? Is it because he actually understood what NVIDIA was doing? Because the results are he outperformed.
Yeah.
But
he has the magical cat with glasses powers.
Or in the case of you know, getting an investment right to the downside, shorting. Is it luck? Is it because you know something? Is it because you are able to look at the financials and kind of decipher, put puzzle pieces together, make assertions about different hints that are laid out? You know, in the case of Perion Networks, well, I can tell you what it was now after the fact, because it's not like something that I'm taking away from club members. But you had the Microsoft renewal happening in November, and previously statements from Microsoft saying that they were interested in pursuing their advertising and being more seriously. We know that Perion is a subpar player. Why? So you would think, why would they keep them? Why would they keep them if they're a subpar player? You look at all the other products that they have, and versus industry, it's not up to snuff for the industry. If Microsoft wants to take it seriously, why would they renew the contract? It would make no sense. And so you can't say that the market was pricing that in at all. There's no way, because it wasn't. And then when the information came out, that's why it fell 40% in a single day. So, but that doesn't disprove market efficient hypothesis. As soon as I would kind of tweak it almost and say, once the information becomes overtly available as an obvious, yes, the market will price it in. Like, for example, if I'm not going to name a company, but there's a company that we're pretty confident is committing fraud. We're very confident it's committing fraud, actually. And I think it's a zero. I genuinely think it's a zero. And I'm kind of going in the past. And Andrew, if he was here, what?
Ebix.
Oh, sure. Ebix. Ebix is almost dead. Okay, Ebix is one. Let's go with Ebix. Yeah, let's go with Ebix, because that one's we can talk about. So Ebix, pretty confident it's a fraud. There's a lot of evidence to show it's a fraud. Somehow it's not a zero. Somehow it's not priced at zero. But a lot of information is publicly available that could indicate this company is a fraud. It is a zero. Why is it not a zero? I don't know. Markets are efficient, aren't they? Because I don't think it's overtly. It's not overt. So to many onlookers and parts of the market, it's not overtly obvious to them. So, and these are smaller businesses. I know that you were talking about larger businesses, but like we already established there are clear moments in time where either the markets are just like not paying attention because there are clear inefficiencies, and the way you can kind of map that out is how the heck were you able to take advantage of that inefficiency and buy it, and then therefore get a relatively highly outsized return for years to come off of that investment. Was it luck or was it something else? So I don't know. I don't know what to say other than that. We can do a rebuttal. If you have a rebuttal, feel free to lay it back. And I'd love to broach this topic because it's a very interesting topic. I see this one. I could have worded it better than and there are indeed occasions when large caps are mispriced. I suppose I am biased because I just don't feel I'm smarter than the market, especially when it's a widely followed name. No, but like I'm saying, like, for example, NVIDIA was one where a lot of analysts themselves were under allocated to NVIDIA, even after it already ran up. And so everyone was saying it's overvalued. There were plenty of people that were laying it out. It wasn't that they were saying, oh, I'm buying it because it went up. They're laying out the framework as to why it's undervalued. Either they're just, I don't know, talking out of their ass, or they are seeing the same numbers I'm seeing, and they understand the industry a little bit more than me. And then they were able to determine, no, this is not actually slowing down anytime soon. So we should buy it at 400, even though it's already up 300%, 200%. They're like, no, it's definitely worth more than this. And we all sit poor for it.
Or we still do okay despite it.
Well, I'm perfectly
I was
happy
gonna say.
with what I've done. No, I'm perfectly happy. That makes it sound like I'm a spoiled little brat who's like, I did 84% in 6 months and I'm pissed. I'm not pissed. I'm happy. So markets also factor in hype and sentiment. There are unknown factors that we haven't really fully accounted for in the theory. But yes, I tend to agree. I mean, like the theory has its like holes still that are somewhat, most of the stuff is accounted for, but that's still, just talking about broadly. Markets have an emotionality factor. Every dog must definitely. So all this to be said, I think that the that is a bad thing about YouTube. Barn Wuffet. Oh, look at biotechs.
Yeah, he missed it.
He missed, like, this is the leader of the cult.
He missed that VKTX got mentioned.
We appealed to the cult. We showed VKTX on screen for a while.
Yeah.
For a while, biotechs.
Poor big Parma still.
Yeah. So, yeah, the question or the statement, every dog most definitely does have its day in the stock market. Is that referring to like every stock at some point outperforms? I guess that's also true. But most companies account for the lower bound of performance within any given year. All performance comes from a minority of investments. How much do you think Meta would benefit from a TikTok ban? Yeah, it'd be fine, but they're doing fine without it because they control the hyperscaler, their own hyperscaler, so they can control their costs. They have a lot of operating leverage. What's your thoughts on the yield curve and reinversion now or reversion now? I'm not making any monetary bets on it, but you can probably surmise that certain asset classes may benefit from the long end of the curve coming down in that kind of inversion, and then the short end also coming down, because that's kind of what the bond market may be implying. But it's tough to say if this time is different or this time is a repeat of the others. I'm not doing any actionable stuff on macro. I think that's most of the time a waste.
Oh, fun question. What is in fact a hyperscaler? It's not a Z-scaler. Yeah.
For what's which one?
Oh, just what's a hyperscaler?
Oh, what's a hyperscaler? So a hyperscaler is basically these large cloud providers. So you have AWS, Azure, Google Cloud, Oracle, Amazon, not Amazon, I almost said Amazon, Meta, but Meta's is only for themselves. There's probably there's Alibaba Cloud, Tencent Cloud, I think, IBM, which no one considers. I don't no. Cloudflare is built off top of someone else's because that's a CDN. So that's it. That's all it is. And so if you think about Meta, they have their own hyperscaler built internally for themselves that services themselves. And so they have a huge advantage.
Apparently SAP on the EU
side.
SAP. Yep.
Yeah.
Thanks, I think every hyperscaler and possible pretender to hyperscaler status has been mentioned.
Oh, forgot to mention, if you guys have liked the live stream so far, 3 hours. Feel free to like and then subscribe if you're not subscribed, and then share it if you feeling so inclined, if you think people in your life that would find value out of this. 3 hours, so a lot of content that they could be doing, house chores. I heard a lot of people like to listen to me while they're doing house chores. So because we have 179 people watching right now, wherever you guys are on the platform. So follow on Twitch. Oh, Fuhad also says follow on Twitch. If you're watching me on Twitter, retweet me, like the tweet, follow me on Twitter as well. Doing cardio right now. Oh my God, Julius. While
There's a reference.
While you're doing this.
I think we have a sticker inside the Discord that summarizes.
Oh, dude, Warren Buffett, you're getting into like the good stuff, by the way, because the topic about small caps, right? Because there's a theory about the small cap factor, and it's small cap and small cap value. Ugh.
Oh yeah,
small cap value. So when you're talking about factor investing and the theory of like what factors outperform over a longer period of time, there's actually, I think, structural changes that have happened that cause the theory to no longer be applicable. And it's funny that there's like a curse that we have. Once a theory is discovered, the application of it suddenly just goes away because maybe it's like an observation of any arbitrage being closed out. Because if it's a theory and it's applicable theory, anyone can learn it, right? Anyways. Did we talk about Trump? No. All right. So every company eventually enters maturity phase and eventual death, and not every microcap can 10x. I suppose my own bias skews my view of large caps since they're likely further along. Oh, yes. So we had this exact conversation, Warren Buffett. Okay. I love this, right? We're about to go for 4 hours now. You just screwed everyone here. Well, actually, everyone has the choice to leave. If they want to leave, if they find this, nerd stuff boring. Do you remember the conversation we have? It was criticizing Oswath.
Yes, Oswath the motor. Yeah, you have your healthy, respectful criticisms, as do I.
Yes, and it's pertaining to his criticism on the small cap value factor being dead in lieu of large cap. So so what I caution Warren Buffett to say is, let's start with this. The S&P of today is different from the S&P of yesteryear in a variety of ways. So let's look at the top 10 companies 20 or 30 years ago for the S&P. What were they? Rhetorical question. I'll answer it for you. Banks, energy, and some tech that was coming up. But banks and energy. Now, banks, they can scale pretty well, but there's inherent limitations on their growth, for sure. And energy doesn't scale as much. It scales, but there's, it's a capex intensive business. And in some countries, you have mining companies like Canada. Canada's like, you have banks, mining. A lot of other countries in the world are still the same in terms of their top companies in their markets are not the same as the United States. The United States has, you have NVIDIA, which is a design house. They're very asset light. You have, of course, Microsoft, Apple. Apple is not very, capex intensive. They outsource it all to Foxconn, but they are basically a design house themselves, but for consumer technology products. And they also do their own silicon, et cetera. But you get the point. And then you also have Microsoft, Amazon, Meta, Google, on and on. And I didn't do it in the proper order. And you have Tesla in there. But the companies that are making up the top companies today are very different. And, even you go a little bit lower, you still notice Visa. Whoa, Visa's in there. You notice, pharmaceuticals have made it up there. I think pharmaceuticals has typically always been towards the top, but pharmaceuticals scale really well too. Because at the end of the day, it's all about you design the drug, and then it's all about after you design the drug, it's marketing and producing it. But you don't even produce it half the time. They may produce it or they may outsource it, but it scales pretty well. But going back to the differences in makeup, what I think has happened is investors have lacked the imagination, which has presented the opportunity, and why maybe it has frustrated value investors to just see the bell curve meme. You have the left part of the bell curve, the dumb guy he's going, oh, just buy large cap tech. And then the middle guy is going like, no, you can't just do that. You have to skew and set a tilt bias towards small cap value, blah, blah, factor, blah, 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 blah. And then the guy with the hood up on the right hand side is going, just buy large cap tech. for like the past 10 years. Like that bell curve is kind of funny to look at because you have the two sides, you know, but anyways, it's a joke. But the joke also has some truth to it because what the right hand side and the left hand side that both agree, the right hand side is basically saying, well, yeah, these are companies that scale like no other. I mean, you know, Meta wants to get into a new country. What's stopping it? Not much. But a bank wants to get into a new country. What's stopping it? A lot. Uh, Google wants to expand across Europe when it wanted to. What's stopping it? Not much. And then, you know, I point out why there's still so much growth to be had for some of these companies. You know, you look at the advertising space and like where is so much wasted dollars still happening in legacy media. It's like, why? There's still more room for them to take, which is hilarious and horrifying to think about how much money is wasted in crappy forms of media. And you talk to people who work in the space and digital advertising, and it's like, no, that's still growing. And likely even during a recession, it's going to grow less, but still grow. And then legacy is going to just lose. So it's about, you know, lack of imagination over like the past 10 years that the top companies in the world, how much they're able to scale. And I said world on purpose, not American, because Microsoft's a global company, Apple's a global company, Google's a global company, Meta's a global company, on and on and on. How easy all of them have been able to scale has astounded everyone's imaginations. No one imagined it. And so it's continuing to surprise people. But it's not that the theory is dead. I reject that notion too, that Oswath says it's a different paradigm. He's basically said in one of his recent, not recent, but I forgot how long ago when we watched it together as a club. And I was like, no, I don't agree with this, because I think that people have a tendency also, and this is also maybe what you're thinking too, Warren Buffett, the point of where people extrapolate the current situation and they say this is going to be the case forever. Happens all the time, and it repeats all the time, and it's going to happen again, and it's going to happen again, it's going to happen again, it's going to happen again, and you will be 80 years old and it will keep happening. People extrapolate the now and say it's the new norm. So
I do have an interesting case point. Would be Airbnb and the broader market, because you remember the narrative way back when, forever ago, early days of Airbnb. Some people said, oh, traditional hotels are dead.
Yeah.
Like, I mean, I'm not saying every single one of them are thriving, but like a Hilton or a Marriott, like market cap wise, they're holding their own. Booking Holdings was older than Airbnb, and you know they've definitely been holding their own and then some. So it's you know, again, time will tell, you know, what happens going forward. But like tech is definitely certainly very, very powerful. I don't mean to undercut it. But
and I know this comment is sort of to poke fun at us for what we're saying, but my response to that is like, I mean, cope and seethe, but at the rate that they've grown and are continuing to grow.
Yeah, I'd say context matters.
Yeah, like, context matters.
Through a relatively big-ish, the amount of companies there, that, you know, it's a fun little case study.
Yeah, like the reason why maybe some investors are just shocked that they've grown this big is because you just simply lacked the imagination. That's all investing is, really, truly. It's about forward projections. How accurate can you get to the forward projections? If you can get more accurate than your peers, then you have something to work with. If you're not, you're going to suffer through it. You're going to suffer for it. End of story. No ifs, ands, or buts. So if you thought 5 years ago, 2 years ago, 3 years ago, I mean, I don't know how many people who are saying it out of their butt that like Meta was dead. All the people saying that Meta was spending money out their butts over the metaverse. They were looking at the same financials I was. I don't know how they concluded that. No idea. The narrative spread like wildfire. Got to $80 a share. 88 was the bottom. No idea how everyone thought that. We were all looking at the same publicly available financial statements. Different conclusions.
Same earnings
wild.
calls.
It was wild.
Yeah.
So lack of imagination, lack of ability, and frankly, it comes down to understanding it, because same thing I could say about Amazon. The Amazon pitch was, I mean, I can say it now, hindsight's 2020, but it was spot on. they could turn on the spigot for cash flows. You just had to understand the accounting framework behind Amazon, and you could see that there was a lot of pent up potential of cash flows. And if you punish them for growth capex, you did the noobish mistake. But it is what it is. So it's a lack of imagination or ability to imagine what's going to happen in the future. That's all the problem is, where people have misjudged large cap tech. And I know it's pissing people off. I know, because it really sucks to just see the left-hand side of the bell curve, and they're on the left-hand side of the bell curve. You're really upset that person is doing well, because they're like, buy large cap tech. I get it, right? But don't worry, they're not doing that well, because when things were like really hairy, they weren't buying. Don't worry, they're not doing that well. They look like you're doing well because it recovered rapidly, and then it just kept going, and then the market assigned a higher multiple, because when Meta was under a 10 multiple, markets were perfectly efficient. I'm joking. I'm kind of doing a joke back at you for the China comment, or the planets comment. And then now when the markets are giving it a 22 multiple, forward multiple, the markets are still perfectly efficient, which, by the way, I still believe. Even though I'm kind of making a joke comment there. So yeah, it's kind of like you're bringing a point here that's very good. Kind of like Buffett buying Apple in 2016 at single digit PE. Everyone saw the same financials, but he made out like a bandit. Precisely. No. Precisely. And I'll say the same thing about Apple right now. I think people are just misjudging. I'm not buying it, because I don't think like the risk reward is there for me. But when I hear people say Apple is dead, I'm like, okay, I think you're misjudging how many spigots Apple has the ability to turn on. If you just look at that business in detail, you're like, oh my gosh, they do this little thing over here, and then just money just pours out. They do this little thing over here, money just pours out, as an analogy that I can provide. And those cash flows are pretty freaking secure. But you have to be paying attention, because that could change. And the setup is not ideal. Right now, the market, I will agree with you in the sense the market all knows that now. Funny enough, you go back in time, 2017, you want to go to like popular media, Jim Cramer does interview with Tim Cook. You know what he says to Jim Cramer? I watched it. Saw it happen, did not buy Apple stock.
He said, booyah, Jim.
No, he said, Tim, in 5 years' time, we're gonna have I forget the prediction, but basically they blew it out of the water. We're gonna have this much in service income, and the margins are gonna be incredible. You can probably still find the interview. They were doing it at the new Apple headquarters. So that's roughly how long ago it was. It was not too long after Buffett bought. I think it was 2017 or 2018 was that interview. I remember Apple was trading well under 20. It was not above 20. And then they were just starting to do the insane buybacks. So, a lot of people saw that, but yeah, that's a good example of how it's a large company, was one of the largest companies, was right in everyone's face. But I still believe markets are perfectly efficient. Well, sorry, backtrack. Not perfectly, because that implies things. I think markets are efficient. So longer term, things show up and become more obvious, it gets priced in. So that means if you're right on a stock, you will be shown that you're right. If you're wrong on a stock, you will be shown if you're wrong, given enough time. It's going to happen. And it's not something to worry. Okay.
No comment from me.
No
I don't
comment
know
from
the
you?
guy that much. Yeah, I don't know the guy that much.
You're enticing me to say it. I do agree that he is. Let me explain why. So he does a lot of, I'll say it in a simple way, there's a lot of overthinking for underperformance.
Hey, that's me.
No,
except not right now.
Okay. Well,
Yeah,
if you want to say it that way. Yeah. So Ben Felix, a lot of discussion, a lot of theory, application of theory. He's the middle of the bell curve. I think that's a great way of putting it. And then it's like a lot of like, maybe slightly above market return in some years, but most of the time it's under market performance. And then I'll charge you a fee on top of that. Like, for example, he has this whole thing, and if you look at the funds at the place he works, they have a the whatchamacallit, no, it's getting late, so I'm forgetting words. Bias, home country bias.
Oh yeah. Yeah.
So a lot of the funds are invested in Canada. So let me say it to you this way. Not all ETFs are the same, because the S&P 500 is really wonderful and unique. Like Buffett is sort of right when he says, I don't think this point does not apply to VT, but it applies to other countries with their own specific ETFs. United States' index, the S&P 500, and the ETFs that track it are more beautiful than you think, because the United States is such a big country, has such a breadth and depth of businesses, you have no idea. So if you go to Canada and you see what the top companies in Canada are, which I already stated earlier in this live stream, what are they? Mining, banks. What are you exposed to if you buy the market cap weighted ETF for Canada? You got a lot of mines and you got a lot of banks and oil. So energy, which pilot into I'll throw it into mining, like all one category, mining and banks, to keep it simple. Holy crap. Talk about leverage the economy. You're leveraged to the economy. You're tied to that thing. Canada economy do bad, that do bad. Energy markets around the world do bad, you do bad. The S&P 500 has a whole mix of things. Oh, sorry, you have Shopify. You have Shopify. Forgot to mention that.
I think your point is great because it also circles into Dom's stocks question of what we think of Buffett indicator, market cap to GDP. Yeah, like in the US context, it's improper because your numerator does not match your denominator. So many of the, if you go by any sort of like market cap or big boy index, we're talking companies with such international, diversified revenue streams that
Yep.
your denominator just seems silly. That's just my opinion.
Yep.
I could be wrong, but
and another point that's really important: GDP figure could also be wrong, because a lot of the companies that are the largest in the world right now, in the United States in particular, have assets that won't be counted. There's value there that is difficult to quantify in the traditional sense.
Yeah.
So yeah, that's the other. Buffett indicator is, frankly, in the modern context, useless. It is useless. It is a distraction. It is not a useful indicator. If you wanted to do it, don't insult Buffett by calling it the Buffett indicator. Just call it for, what it is by the mathematical definition, and then create your own that does, like, if you want to be as accurate as possible, try to, well, you're going to have to do a lot of work, but create a weighted based off of each individual company's business units within each country and where they draw their economic benefit from. So you can do that, but frankly, it's useless. And I see a comment on the SBX NK. Oh my gosh!
Yeah, the ranking of those three.
You go first. I already know which one's last.
I think I agree with that setup in that order. Starbucks first, then Nike, then PayPal.
I might come in unpopular opinion.
Oh, fire
yeah.
away.
Okay, there's a reason. I'll say why. Well, actually, no, even on current value, I'm gonna be ranking, because I have no money in this except like a small position in Starbucks. But I would say Starbucks first, then PayPal, then Nike.
More room to fall.
Yes, that's why.
Yeah,
that's that's exactly why. Because I think Nike's coming off of a very expensive valuation.
Yeah,
and so there's no growth to be had, and I don't like a thesis that relies on multiple expansion. Neither does Andrew. So if Andrew was here, I think he'd say the same thing, because I think the Nike thesis, based off of growth that they're even projecting, even if you go like double it, it doesn't really give you the valuation or justify the valuation all too much, unless you believe the market's just going to magically keep the multiple the same, and then it's going to have multiple maintenance plus growth. And so I don't like that setup. The PayPal setup is still like, it is cheaper, inferior business, undoubtedly than Nike versus like the brand power, more commoditized. So there's that. So I don't even think it should trade at an elevated multiple. I had a discussion with someone today that thinks that it should trade at like a 20 multiple. I was like, under what argument? Does that make sense? So just taking that into context, I think like PayPal at the current multiple is fine. And then you get, share count reduction, good buyback yield, some growth in there. So the multiple could expand. You may not need it to expand, but if there's serious business deterioration, all three of these companies have a challenge though right now. So neither of these are like clear cut and dry. They're all challenged. Starbucks could be cheaper, honestly. And frankly, I think it's going to get cheaper before it gets, I don't think it's out of the storm just yet. But I think it's probably the highest quality business between these three. I know that's going to ruffle the feathers with some Nike guys, but like, I think Starbucks is higher quality than Nike. That is going to like piss people off. They're going to be like foaming at them. I was like, how dare you say that? But all dead money for a while. Oh yeah. Is that John from the club?
Maybe. I'm not sure.
Because John in the club is just John. So I don't know if it's John Chris. John, is that you?
Not sure. Just ping us if it's you.
Because it's not spelled the same. He puts an H in his John.
Mm-hmm.
Anyways, isn't the multiple expansion part for the BTI thesis? Is that British Warren Buffett?
It could be, but I don't think so. Like, I think it's more so just the buyback. I mean, granted, like you'd like to see that buyback spigot get turned on.
Wait, there were two followers who were Warren Buffett. There was Warren Buffett. That's not. There's another Warren Buffett guy. There was a Canadian. I think it was Canadian Warren Buffett and British Warren Buffett.
Yeah. This isn't British Warren Buffett, I don't think.
Okay.
Because usually he like says who he is.
Is there? I saw another question up above. This one we'll get to this one. Coal stocks. I think.
Yeah.
How do you feel about coal stocks?
You were right. It is legitimately cheap. It's just that like just about every single coal player out there have all said we're devoting money to CapEx. Here's your dividend, maybe a paltry little buyback. Screw you, go away, leave us alone. Basically. So like if they ever do turn on the buyback machine properly, then that changes the story. But like, you're devoting money to CapEx and we'll see how that plays out.
They do the same thing every time.
Yeah.
Every time, rinse, repeat. They never learn. You always say, they learn this time. They're different. No. All right. So there has to be a Nike price point where you would buy it. What is that price? I'm trying to read it in the.
What is that price?
What is that price? He's like shaking me.
Yeah.
Like,
Strangling.
65. Please. I don't know, because I haven't thought on it too much, but because I just don't like apparel too much, like shoes especially. Crocs is different. Crocs is special. Crocs Crocs is another one. Crocs is another example of a company where all the information was there and it was very cheap. By the way, let me say as a point of like review on myself from a while ago, one of my first Crocs videos, I came across, I was like, I'm not buying this. There's a reason why this is cheap and I just don't know. I should have looked into it more, because what I basically came out with my end analysis was like, this is like one of the cheapest stocks I've ever seen. Turns out, not only did I make that video like at the bottom when it was like stupid cheap and I was too chicken to buy, because I was like, there has to be something wrong. Turns out it was like an insane performer from that price for a shoe company. I got in late.
Me too.
So I didn't get in at 50. Got in the 80s. It's not bad. But yeah, another example of like, all the information was there.
Yep.
A lot of.
I want this to be on record though. I am still anticipating an awful 1 or 2 more quarters this year. So like, expect me to get punched in the face, and we can all point and laugh at me, because I'll join in on the laughter. But I still think long term it works out okay. Maybe that's me being foolish.
Yeah.
Yeah,
Oh,
but
there's some
I'm waiting for it. It will happen. I'm pretty sure. Like, because this one jumps around violently.
Bacon, you see what happens? You stay on this long, people start asking really good questions.
They do.
They ask great questions, and that's what happens. That's why just go on for lives for like 4 hours, and it's like, great question, great question, great question. Because I'm scrolling through, and I'm like, damn, that's a good question.
Yeah. For me, it's not so much of a price.
Oh wait, we're still here.
Yeah, like I want clarity on the market, because Anon and Hoka, if they continue to stay focused,
Yes.
that really worries me. Then yes, I agree with your assessment. Nike would be maybe even subpar to PayPal.
Yeah.
But if
The
if
one
they
I'm
pull an
worried
Under
about is
Armour,
on.
yeah, like if they pull an Under Armour though and get sloppy, then Nike's superior to PayPal.
The reason why I'm more worried about Anon than Hoka's is Hoka's as a brand. I know this sounds silly, but Hoka's as a brand, I feel like it's going to have a harder time expanding away from shoes. I think they have fantastic shoes, and Deckers has done a great job at getting into apparel, which is where Nike, they started with shoes and they got into everything, and they became this powerful brand. I think Anon is doing the Nike playbook where they started with the runners. They get the runners, and same with Hoka's. They're going after the runners, and between the two of them, they're securing that base, and everyone else is losing them. And then from there, they may decide to expand into other apparel, other shoe categories. Maybe they go into cleats, etc. Who knows? Who knows? But right now, this kind of like the waters are being tested. The sky's the limit for the new guys, and Nike's the one that's fighting them off. I have pairs of Ons, 2 of them. I love them. I will not buy a new Nike shoe. I never cared for the brand, so I'm probably one of the worst people. But like, I did have Nike shoes, and I was like, I wore these Ons, and I was like, oh. And I'm also going to go buy some Hokas, and I'll let you guys know how they feel. But I've heard good things about Hokas. So
yeah, I know clarity sometimes undercuts the gains you could have, but I think I can afford to wait for clarity. I'll accept that trade off. This is me being a coward. What was the other question? It seemed like it was good.
The other question was this one. Isn't the multiple expansion part of the BTI thesis? That plus buybacks. Can it negate a potential menthol ban? Also, Paul owns it, so I'm out. Funny you say that. I legitimately recently sold BTI because Paul owns it. So surprise for all of you, because I forgot I didn't mention that this whole stream. So
I'll own up to it though. I'm still in BTI, and I don't think multiple expansion is part of the thesis. It's just the buybacks for me, given how lowly priced it is. And I recognize the counter to that is, why can't you just wait for the dividend to be turned down and for the buybacks to really kick in? And that's very fair. But there have been signs that they've at least tried to make meaningful moves in that direction, the best they can. And when it comes to the menthol ban, there have been some regulatory signs in some localities that point in that direction, and also some that counter that direction, as well as some alternative products. So if we view that as a wash, it's not priced for that much. So I'm okay with just sitting and chilling.
Fun fact: the Chevron doctrine was overturned, I think today or yesterday.
Oh, really?
So, yeah, it's over. Supreme Court.
Shout out Kells.
Yep. So that's important for British American Tobacco, and I think you'll do fine if you're out there and you own British American Tobacco. But yeah, the buyback, I don't think you necessarily need a multiple expansion for it to really work out, because if you're judging returns from dividends plus capital appreciation, and the buybacks do something, you have multiple maintenance. With the buybacks, earnings or net income remains flat or goes up slightly or goes up even a lot, then at that point, you have your returns. If you get multiple expansion, you get crazy returns. Now the implied return is very good. So I have my calculations probably as to when I would probably get back in. I may end up regretting selling it in the first place, but we will see. we will see. I bought something else with the money. So.
Yeah, there are plenty of great opportunities out there, and also similar opportunities with the quote unquote "it's cheap" idea.
Yep.
So it's fine. But yeah. Shout out to club members. To Kells, did a great write up. Turns out it played out. So I encourage people to read.
That was a great write up. It turned out spot on. After what point would you just index all your money and not focus on investing? I don't think my young self says never. My older self is unknown. So I don't know. But my young self, which is now, I derive too much enjoyment from it to let it go. And, for the time being, at least through my current investing career, it's been fine. So
my current answer is I'm already indexed a healthy amount, and I do it just because I really love researching the world around me. This is a way to do it, to learn more about the world around you, because there's a lot of awful narratives out there. And it's amazing when money's on the line and you get to see, what's true, what's BS, what becomes true, and what lies end up getting shifted out. It's great times.
Yeah, I think this, genuinely, in my elderly years, is going to keep me sharper. If I keep doing it, it'll help keep me sharper. Of course, for example, I'm even focusing on it now because I think with portfolio maturity, you get to a point where you start to focus on preservation, which is natural. And again, you guys, I already showed you guys that 16, what is it? Let me get the exact percentage because it changes daily. 16.08% of the portfolio is in fixed income. It's as boomer as you get.
Yeah.
It's like preferreds, munis, and CDs. That's not really going to fluctuate all too much. So I have been sort of storing cash away. And yeah, it's probably going to, it is a drag on my performance. So what? But as the portfolio grows, and I also focus on growing the cash pile, it's funny, I was just thinking about that. All the income people, it's like they just don't listen. It happens naturally. If you focus on total return, you grow the portfolio, it'll naturally just come.
I do think, though, to temper ourselves, like fast forward, and you did mention this, older Fabio, like the risk of, God forbid, bus hits you. You may be good at this, which is a very hard bar, and I'm saying the general anyone. Anyone may be good at this, but bus hits you, you're not able to make moves. You leave your significant other and/or kids, loved ones, with very concentrated positions. Like, would you like at least leave a memo on what to do? Because there's stories, like silly stories of like people getting like a huge amount of Microsoft shares and they don't know what to do with it. Just as a random example. So it's food for thought. Different type of perspective on managing assets.
Yeah. We'll see what the future has in store.
Oh, Warner Brothers, or not Warner Brothers, Walgreens Boots Alliance. Oof.
Yes.
Not great,
yes.
Bob.
Not great. I looked at it. I didn't feel too comfortable with it given the entity and the complexity of the entity behind it. I think in that case, like the market has genuine concerns about, and I'm not going to reveal it. Don't worry, out of respect for Chris. But yeah, I have concerns about how that parent company is going to treat the subsidiary, and if the subsidiary is going to be allowed to just potentially default and refinance, which could happen. It's not at a risk to the parent company. The parent company is completely separate from them in that regard. So it could happen. And I think that's what the market, especially in the debt markets, just so we're clear, in very rare instances, is there inefficiencies? Because in the debt markets, oh my gosh, there are some very, very sophisticated players, and the 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 math is a bit easier. On top of that, it's less about imagination. It's literally about, this is the agreement. This is how much I'm going to get paid. What are the risk-free rates? And, from there on, what's the credit rating? So the factors are a lot more known. So inefficiencies they happen, but they're rare, but they happen. I'm trying to think of, here's one. But you see, it takes imagination a little bit. So this is one that played out. And I'm not talking about the ones that happened during COVID. Like during COVID, the bond market, there were some inefficiencies. You could go around. I pointed out to one preferred stock many live streams ago. That was, you remember not the Pebblebrook, sorry, the Herschel Hospitality.
Yeah, it was a great one though.
That one went up 700% total return. Preferred stock.
Mm-hmm.
The commons, terrible investment. The preferreds, 700%. So there are times, but generally speaking, fixed income in normal points are fairly they're priced appropriately for the risk. So it's not guaranteed, because if it's guaranteed, just buy anything. The higher the yield, the better. But no, the higher the yield tends to imply that there is greater risk. So like, for example, you can go AMCX stock, or not stock, bonds. You can get 14% every year until 2029. What does that imply? There's some risk there. But I was trying to think of the recent not arbitrage, but
the one in the club.
No, that was an interesting one too.
Yeah, that one, like it was respectable games given the timeline. Not crazy though.
There was another fixed income opportunity. Oh gosh. Oh no, and I literally forgot. I'm so sorry. But oh yeah, the one that Card Imagination just came back to me was AMC, the theater company, and GameStop. Both of them.
But the bonds.
The bonds. Because if you thought about it for a moment and you said, they're going to dilute and raise capital, what are they going to do with it? Oh my God, they're going to buy back the debt. What is the debt priced at? Oh my gosh, it's yielding 20%. 20% yield to maturity. Oh my goodness. And then so if you put two and two together, you could have been like, okay. So that's rare, but those are like, you see the instances, like it's taking something outside of the realm of the previous agreements, and you're speculating. This is that's some Howard Marks type stuff. You're speculating on a re-rating, you're looking at the business, and you're saying the business is doing something, and then that's the reason why I'm going to speculate on the fixed income. And it's distressed fixed income, and I'm going to be right on it. And that's Howard Marks' story. He was amazing at that.
Yep.
But will you be?
Hard to say. But yeah, credit to Boba the dog. I don't even know about what preferred shares specifically are being mentioned. So integrity kept. Yeah, you don't need to tell me. It's all good. Yeah. Yeah, because if it's structured like what you've hinted at, no, I'm not interested. I would rather have parent co. Like, annoying ownership structures annoy me.
I have not bought any of those. Okay, so I think that is the end of questions. The bad PE bacon.
Shout out Emperor Sauron. Oh, you maybe I don't know. I
think Emperor Sauron knows, because we've looked at it in the past as like a club, but without finding out. Yeah, coincidental.
Yeah.
So,
boy, oh boy, do we hunt everywhere! I swear.
Everywhere we're hunting everything and anything as a club, which I love it. All right, so I think we're good for 3 hours and 51 minutes. With that being said, again, if you guys enjoyed this live stream, you enjoyed the content, feel free to like, share, subscribe on Twitter, heart it, retweet it. If you're on Twitch, Do whatever the thing is on Twitch, and then yeah, leave a comment if you want to interact with me afterwards. If you're curious about joining the club, recall my warning: do not join under the other circumstances. If you're looking for a community of people, a club, then we might be the right place for you. If not, we may not be the right place for you. So just keep that into consideration. Link is in the description below. With that being said, I think I'm better at reminding people that's even there. With that being said, thank you guys so much for joining us today. And timestamps for anyone. So it's 3 hours. Well, the end of it's a Q&A. So it's like, if you watch, you watch it. All right. The outro.
Okay. We'll do it live. Okay. We'll do it live. It. Do it live. I'll write it and we'll do it live. F***ing thing sucks.